Hello, everybody. How are you all? Welcome to the class, all the bankers. This is Radhika Dua, and today you and I will do our ABFM Module C together. I hope you all are really excited for this because this module especially has a lot of numerical parts. And we know last time this exam was difficult, and this time we can be more productive out here by preparing in advance, right? So let's start. I'll wait for 2-3 minutes so that everybody can join in, then we can start the session. Am I audible to all? Please do let me know in the session. Good evening, Rani ma'am. Please let me know in the chat box. Am I audible to everybody? So, okay. We will just wait for 2 more minutes. Good evening, sir. Good evening, everybody. We'll wait for 2 more minutes, then we'll start the session. I hope you all have joined in. There is no voice issue as well. If everything is fine, just give me a thumbs up. I'll understand that all clear. Everything is clear. Okay. Rani ma'am, today's session we'll do the best. From tomorrow we'll be doing B module as well, module B. So more than 50, not just 50. Our target is much higher, right? Okay. So just one more minute and then we'll start. Till then, what will happen is, let me tell you how it will work. What we will do is, we will revise the concept. We will not take a lot of time on that since we have already done that in our paid classes. I'll give you the gist so that we can solve the questions. And after that, if time permits, we will do numerical portion as well. We'll cover a lot of numerical questions once we are done with the normal questions that we'll be doing right now. And after that, we'll do all the numerical questions together. Because I want to cover maximum units and the numerical portion as well. So we'll do both the things. Okay. So somebody has raised their hand. Mahesh sir is there. Okay. So let's start. Okay, so I guess those who wanted to join would have already joined. So we'll start the session out here and how it will go about. So let's start. Module C, the first unit that we have is unit 13, that is corporate valuation. Now, before I tell you what is there in the chapter, let's have a basic understanding how ABFM works. ABFM is all about valuation, merger, calculating values which are required today as compared to what they will be tomorrow. So just give me 1 second, please. Okay, so let's move ahead. So what happens in ABFM is that, especially corporate valuation, discounted cash flow, other cash flows. So your focus should never be on formulas, but your focus should be on conceptual clarity. If you have conceptual clarity, if you can think that this is my money that I'm going to put in, if I have to buy a share, I have to find out their valuation, the intrinsic value of that share, right? In real life, how you do it, if you can think in those terms, it will be so easy to solve the question. So easy, because when you think of this money as your own money, that this is my money, whether I should put in this project or not, you will do all the maths that is required, you will do it, right? So here also think like this is your own money, and you have to you have to not calculate something but logically absorb something, so then it will be all good for us. So let's start. So what is corporate valuation? I have a business. In this business, I want to invest somebody else wants to invest in this business, my business. What will they do? They'll try and calculate my intrinsic value. And there are various ways of doing that. What if I want to invest my money in some other company via shares? How will I do that? How I will calculate their corporate valuation. And it is required especially when merger acquisition is there. IPO is to be IPO amount is to be decided. There are certain sort of buyouts. There are certain for tax purposes we do this. So it is what this is nothing but a process of determining the economic worth of a business. When if I want to buy your business, then I should know how much is what is the worth of your business. Only then I can buy it out, right? If I find out that the worth of your business is, let's say, 12 CR, so I will offer you maybe 10 CR. Then after negotiation, if the amount is still 12 CR, I'll be fine paying it. But anything beyond 12 CR, I'll not be fine paying it. So I'll not pay beyond 12 CR. That is how corporate valuation works. So it is helping you with economic worth determination. Very important for MCQ, for a business, for a company, for a share, for any division of any company or the assets. So all 1, 2, 3, 4, 5. You have to understand that if we are trying to find out the worth of any of these, it is corporate valuation only. It is specially done. I have done when we find out corporate valuation. These are particular cases. What factors will affect my valuation? How much is the company earning? Plus future predictions. What is the growth rate? All these things will tell me what is the valuation of the company. What are the cash flows today and future? What is growth rate? What is the risk involved in this company? If I put my money in this industry, is this particular company, what are the risks associated? What are industry conditions right now? What if the industry that I am putting my money is already sinking? Why do you want to put your money in? If the company is not in a sustainable position, even if the worth is high, I should not put my money into it. Economic environment. So these factors will 100% determine that what should be the valuation of the company. Now, very important for you, very important for understanding that price is different and intrinsic value is different. Let's say with my calculations, I calculated intrinsic value of a particular company and their share should be valued at 220 rupees. Right now, the price, this is the intrinsic value, this is the correct worth. The correct worth of the company via mathematical calculations, right? But right now, this particular share is traded at, what is the price of it? It is traded at 250 rupees, implying that the share is overvalued. This price is overvalued. So be clear, intrinsic value is different and the price is different. Price is nothing but what is prevailing in the market right now. Due to some unjust demand, due to some market conditions, it is above its intrinsic value, meaning that this is overvalued and it will come back to the original correct intrinsic value for sure. One thing about market that you should understand, always keep in your mind, that you will come back, the market will take correction and you will come back to your own worth. So when I'm saying the price is 250, it is overvalued, I should sell it. It will come back to its correct value for sure. Now, intrinsic value versus price are two different things. In value is intrinsic worth, the correct value, and it is theoretical. And on the other hand, price is actual amount paid, the market price, and it is market determined. Very important, the price is market determined. Okay, but we will always come back to intrinsic. That is very important. You should understand that. Any doubt till here? If you have any doubt, please ask. I hope there are no doubts till here. Great. Moving ahead. A lot of questions that are asked in MCQ related to intrinsic value is, a company's intrinsic worth is known as the cost of the company? No. The price of the company? No, this is market determined. The dividend of the company? No, this is the value of the company. This is the value of the company. Okay, some important formulas that you should keep in mind. There are different ways of calculating the worth of a company. First is book value, which is your net worth divided by your number of shares. Market value, your current market price. Intrinsic value. What is intrinsic value? Most important. This you'll use in all the units, almost all units you will use it. That if my earnings are different in coming future years, right? X1, X2, X3, X4, even if they are same, there are different sort of cash flow, different sort of earnings that I'll have over the years. What is the present value of these earnings? This is known as nothing but intrinsic value, the correct value, right? Then you have liquidation value, that if I liquidate the company, then how much will be the worth? If the business is to be shut and all the assets are to be sold, then what am I left with? Replacement value, that if I replace this particular asset today, what will be the cost of it? Always understand, for exam purpose, book value will not be equal to market value. These are two different concepts. Okay, moving ahead. Let's do the questions for unit 1. Are you all ready? Same that we have been doing it till yet. We are going to play Kaun Banega Banker, KBB, and same rules that we had in ABM. Fastest finger first. Whosoever will give the first answer, the correct first answer, will get 1 lakh rupees from my side. And for every negative wrong answer, there will be negative marking. Okay, let's do the questions then. Question number 1 on your computer screens. A listed manufacturing company, Tata Steel, was evaluating the acquisition of a smaller engineering firm. So they are trying to acquire some other firm. If Tata Steel is trying to acquire some other firm, what will they do? They'll do corporate valuation of that engineering firm, right? During the board discussion, the CFO highlighted that the target company's market capitalization was 1200 crores. What is market capitalization? First of all, tell me that. Market capitalization is how much share of the market have you taken up. That is your MPS, market price per share, into number of shares. Give me 1 second. So what is market capitalization? Let's write the formulas also side by side so that you can revise it. That how much share of the market have I captured? So that is your MPS, current price, into number of shares, floating shares. Okay, so that is 1200 crore, while its enterprise value, that is the value for the whole enterprise including equity and debt, was estimated at 1650 crore. Okay ji. After considering debt obligation, lease liability, preference shares and cash reserves, we calculate enterprise value after taking consideration everything, of course. Some directors argued that the acquisition price should be based on equity value because shareholders are the legal owners of the company. Others listed that the complete valuation should account for obligation owed to lenders and other stakeholders. Simultaneously, an investor banker advised management that the valuation exercise must align with internationally accepted standard, IVS, that we do, right? And fair market price principles, correct? To avoid dispute with regulator and minority shareholders. Absolutely correct. What the investment banker is saying is right. We have to follow the international standards, plus we have to follow fair market valuation as well. Consider the following statements. Enterprise value generally include equity along with debt and certain financial obligations while reducing cash and cash equivalent from the computation. We have already done what is enterprise value. So what is enterprise value? I'll give you the quick revision of all the concepts here. Okay, so what is enterprise value? Enterprise value is the correct value available for everybody, for the whole enterprise. That is your shareholders, that is your debt holders, other financial obligations, but cash and cash reserves are not included in it. Why? Because cash and cash reserves, we stated that this is not a part of We assume that this we already have. Rest we have to distribute. That is why cash and cash equivalents are not taken, right? So do you think equation number 1 is correct? What do you think? Equation number 1 is correct or not? Of course, yes. Equation number 1, statement number 1 is correct. Enterprise value is this only. Enterprise value is this only. How much is the company supposed to pay its shareholders, its debt holders, its preference shareholders, other obligations if any? But we will subtract the cash reserves. Why? Because this is something that we already have. Book value is always identical to fair market value because both are derived from audited financial statements. Do you think that is correct? Just abhi we have done in our notes that no, book value is not equal to market value, and not always it will be equal. It might be equal or might not be equal, but in 90% cases they will not be equal because book value is historical value, market value is current value. So this is incorrect. Fair market value assumes that both buyer and seller possesses reasonable knowledge of relevant facts and are not acting under compulsion. They are saying, of course, this is correct. We are assuming if two people are buying. So I think somebody has raised their hand. Dheeraj sir wants to say something. Yes, Dheeraj sir, go ahead. Is there anything you want to ask? Please go ahead. So the given statement is absolutely correct. Why? Because when two people are in the transaction, we assume that both of them have reasonable knowledge of what they're buying and selling, and there is no compulsion. This is also absolutely correct. Next. Market capitalization reflects only the equity portion. Market capitalization reflects only the equity portion of company's value and does not directly incorporate debt obligation. See the formula. What is market capitalization? That how much of the capital, how much of the market have you captured, which is market price into number of shares. We have taken only equity portion only. So this is also correct. International valuation standards, that is IVS, discourage the use of multiple valuation approaches while determining firm value. Wrong. This is wrong because IVS does appreciate and does encourage that use different valuation methods to calculate your determining the firm value. So this is wrong. So 2 and 5, wherever you can see 2 and 5, get rid of it. So not correct. B is the correct answer. Absolutely right. And who gave me the first answer? Rani ma'am. Very good. So 1 lakh rupees to Rani ma'am. So I'm going to write it here. Next question. See, I've written. Please, I'll share this PDF also with you. In the free section, it will be there. But I've written the formulas for your own benefit. When you go through the PDF once again, remember these formulas. Okay. A diversified conglomerate Origin Vista Limited is evaluating 3 subsidiaries for strategic reconstruction. Okay. The manufacturing division owns large parcels of industrial land acquired decades ago. Okay. The fintech subsidiary has rapidly growing but projected cash flows. So the future cash flows are volatile. We understand that. And the logistic arm recently suffered operational losses after a regulatory disruption. So the logistical arm is suffering losses because there has been certain regulatory changes. The valuation consultant appointed by the board noted that the market data for comparable listed companies was limited, while management projections for certain divisions were highly sensitive to assumptions regarding discount rate and future synergies. The consultant also warned that mechanically averaging values generated under multiple methods could produce misleading conclusion. He is right. if there is a difficulty in determining what are my future values, there's a difficulty in understanding that what is the discounting factor. If these are future values, how do I bring them back to present value? Only then I can find out my intrinsic value, right? There is a problem. Now he is saying that if you use multiple approaches and then average it out, it will give you misleading results. He is right. Which of the following statements regarding corporate valuation approach and practices are correct? Okay, let's do it. Should I go away from the screen? I think we are unable to view all these. Just give me 1 second. I'll go away from the screen. Yes. Yes. Option number 1. Under the market approach, adjustments may be necessary to account for qualitative and quantitative differences between comparable assets and subject assets. Correct, absolutely right. When I go with market approach, I always make adjustments as per the market valuation, right? It is necessary to make adjustments for quality and quantity between comparable assets and subject assets. This is absolutely correct. The income approach generally derives value by discounting or capitalizing expected future economic benefits. Yes. Under income approach, what we do is we do discount the future value. So if I have year 1, 2, 3, 4 with me, and the future cash flows are 10 lakhs, 12 lakhs, 14 lakhs, and 15 lakhs. What will I do? I will discount them and bring these values today. That what is the value of these amounts today, right? So am I not doing this? This is absolutely correct. Correct. The cost approach is ordinarily considered more suitable for business whose value primarily arises from future intellectual property monetization rather than identifiable assets. Wrong. It is just the opposite of what's the correct answer is. The cost or asset based approach is generally more suitable for asset intensive entities. So this is wrong. What they're saying here is wrong. Cost approach is more beneficial for asset intensive industries. Always remember that, because they might ask you this question as well, that which industry is more appropriate for cost approach. So this is wrong. Fourth, where multiple valuation methods are applied, professional standards encourage reconciling through informed judgment rather than simple arithmetic averaging. 100% correct. A valuer may rely on a single valuation method if sufficient confidence exists regarding its appropriateness and reliability under the circumstances. Yes, I can follow this one method. Only thing is, whatever information that I have should be 100% correct, and I'm confident that whatever information I'm using is relative for me and relevant for me. Both the things. Relatively correct and it is relevant as well. So third is not correct. So wherever you can see 3, get rid of that. All other are correct. So D is the correct answer. D is the correct answer, and nobody has given me the answer. So I'll take 1 lakh rupees for myself here. Please, I want your answers there in the chat box, everybody. I would need your answers. Okay, next question. Am I audible to all? Did I not get the answer because there is some network issue or something? Is it because of that? Is it visible to all, audible to all? Let me check on YouTube. It'll be good if you can give me some sort of information out here. Okay, so it is going on. It is there on YouTube. No issue. Okay, thank you, Rani ma'am, for letting me. Okay, thank you on YouTube as well, audible. Okay, thank you so much, sir. Okay, moving ahead. Next question. So D is the correct answer. Next question. A private equity firm is evaluating the acquisition of a manufacturing company engaged in industrial equipment production. Okay. The company owns old factory land purchased decades ago. Okay. Specialized machinery, patented processes, software, and a strong supplier network developed over many years. Okay, we understand that. During sorry. During due diligence, the valuer observed that the balance sheet significantly understates the market value of land. So understand, I bought a land decades ago, and it is still still recorded at book value. But right now, the market value is quite high. While certain machines have become technologically obsolete, some machines have no valuation at all now, being only partially depreciated. So both the things are happening. There are assets which are undervalued, and there are assets which are overvalued. The firm is considering whether to rely on adjusted book value, replacement cost, or liquidation value approach for valuation. Which of the following statements are correct regarding valuation under the adjusted book value? Adjusted book value approach, also where it is also around how market value works, right? Statement number 1. Under the replacement cost approach, land is generally valued as if vacant and available for sale in the market. So if you want to replace it, so I'll assume that it is already vacant and it is ready to be sold. This is what they are trying to say. Yes, this is what replacement cost means. That if I have to replace this land, it is the vacant land. Let's sell it. So this is correct. This is 100% correct. Organizational capital such as supplier relationship and employee coordination is usually fully reflected in the balance sheet book value. Is it possible that in the book value you can tell us how good of a relationship I have with the suppliers? No, this is wrong. Wrong. Liquidation value approach is more appropriate where the enterprise is worth more as separated assets than as a going concern. Do you think this is correct? This we took in our class as well. This is 100% correct. Liquidation value becomes relevant where dismantling and selling assets individually, it will yield you higher value. Because if I take it as a going concern that all the business will keep on working for a long foreseeable future, it will not work. So what will I do is I'll pick up individual assets and try and sell them. If this can yield me better, higher returns, then why not do that? So liquidation approach, yes, this is correct. Next, finished goods. Okay, yes, 1 second. Finished good inventory is commonly valued by deducting estimated selling and distribution expenses from expected selling price. That for inventory, if my expected selling price is this much, I have to deduct selling and distribution expenses. Then this is my net estimated selling price. This is correct? Yes, this is correct. Inflation may cause historical book value of assets to diverge materially from their fair market value. Yes, correct. Whatever is there in my book balance sheet, whatever is my book value is historical. It is not representing what is there in the market. So this is also correct. So only 2 is not correct. So wherever you can find 2, get rid of it. So A is the correct answer. A is the correct answer. Very good, Rani ma'am. So Rani ma'am, 2 lakh rupees to you now. People on YouTube, I need answer from you as well. Next question. So I have given you the relevant explanation as well. A valuation analyst is assessing the adjusted book value, similar to market value, of Zenith Industrial Components Limited using the replacement cost approach. The following information is available. Cash and bank balances are this much. Receivables are 30 lakhs, of which 10% are expected to be irrecoverable. So 30 minus 10% that I'll never get. Raw material inventory recorded at historical cost 18 lakhs. Current replacement cost is 20% higher. So add 20%. Finished good expected selling price 40 lakhs. Okay. Estimated selling, transportation and collection expenses on finished goods 6 lakhs. So 40 minus 6. 34. Land recorded in books at 25, current market value at 70. Okay. Plant and machinery book value is this much. Comparably used machinery market value including installation cost is 58 lakhs. That if I go into the market and if this my current machinery is 10 years old, if I take similar 10-year-old machinery from the market and get it installed at my premises, how much cost will it take? So 58 lakhs. Okay. So I'll take 58 lakhs. Non-operating investment market value. So they have given me market value only. The company also has outside liability 52 lakhs. I'll have to deduct this. Based on adjusted book value approach, what is the approximate net adjusted value of the company? Giving you 1 minute's time. I've already explained you the answer. I would like to know what is the correct answer. I would like to know what is the correct answer. All of you. I'll also take a fresh page and I'll try and solve it for you. So let's try and write everything. Why not? Why to take a fresh page? I'll just write it over here only. So yes, will I take cash? Yes, I will take 12 lakhs as my cash. Market value, book value and market value of cash will be same, exactly same. Cash value is not changing, right? Now receivables on the other hand will change. Why? Because 30 lakhs is there, but you have to deduct 10% as doubtful debts. So we are left with how much? 27 lakhs. 12 lakhs, 27 lakhs. Everything is to be taken as per the market value, right? Raw material will be 18 lakhs and the replacement cost is 20% higher. So the market value will be 18 lakhs into 1.20, right? Which will be, because 20% you have to increase. Either add 20% to it or just multiply it by 1.2. Same answer. Which will be 21.6. Next. We have finished goods. So finished goods will be, I've already done it. 40 minus 6, 34 lakhs. Next I have is land and the current value of it is 70 lakhs. So let's take 70 lakhs out here. Then I have plant and machinery and market value of it is 58 lakhs because comparable assets same. If I get it from the market and include my installation cost, it will be 58 lakhs. Then I have some other investments which is for 15 lakhs. Take a total of this, which will come to around 1, 2, 3, 4. It will be 237.6 lakhs. Subtract your liabilities from it, which is 52 lakhs. What am I left with? 185.6. So B is the correct answer. B is the correct answer. I hope you were able to solve it. I hope you were all able to solve it. Oh, you were unable to see my screen. I hope it is all clear now. So cash, I'll take it as it is. Receivables, I'll deduct my doubtful debts from it. Raw material, the correct market price. Finished goods will always be estimated selling price minus your expenses. Land, what is the correct current fair price of it? Same, fair market valuation everywhere. Fair market valuation everywhere. So B is the correct answer. Very good. Tanmoy sir, very good. B is the correct answer. Shabash. So Tanmoy sir, 1 lakh rupees to Tanmoy sir from YouTube. Okay, next. B is the correct answer. I've solved it for you. I've written it here as well. So wherever is more comfortable for you. Okay, I'll just have a water break. You all can sip some water. In the meanwhile, please, let's take a short recess. Okay. Next question. Okay, before we move to next question, let's take a 4-minute break and then we'll start again at 6 o'clock. Let's all have some water break, all of you. Okay, so let's start again. I hope I'm audible to all. Okay, just 1 minute. Okay, yes. Very sorry about the delay. Let's start again. Am I audible to all? Okay. So the next question is, a listed infrastructure company, Horizon Grid System Limited, is evaluating a merger with an unlisted renewable energy. So if it is unlisted, it is difficult to find out its market value, right? During negotiations, the investment banker observed that the company's share price had sharply increased after the announcement of a new government transmission subsidy. So the share prices have sharply increased after there was some subsidy change. However, some independent valuer argued that the company's market capitalization on the valuation date should not be relied on entirely, because speculative trading and temporary volatility may have distorted the true enterprise value. Okay. The board also debated whether debt instruments trading below face value, for example debentures, okay, or bonds, they are trading below face value, should be considered at book value or market value while estimating the company's worth for the merger ratio, with reference to valuation under stock and debt approach. Important approach. And related concepts, which of the following statement is correct? Which of the following is correct? Okay. So the first statement is, under the stock and debt approach, enterprise value is generally determined by aggregating the market value of equity and market value of outstanding debt instrument. If you are taking stock and debt approach, do you think the enterprise value will have market value of equity plus market value of outstanding debt or not? First of all, the market value, enterprise value is anyhow equity plus debt. The only question here should be whether it is market value or not. So yes, it is correct. It is market value only. So this is correct. If capital markets are perfectly efficient, averaging share price over several months necessarily produces a more accurate valuation than using the market price on the valuation date. That rather than taking what is on the valuation date, let's take over the public information over the time. Wrong. This is 100% incorrect. The market efficiency hypothesis says that the current market price already reflects the publicly available information. Therefore, any sort of proponents of market efficiency of averaging the price will be wrong. It will reduce the price, which is not correct. So this statement is 100% incorrect, since any information which is available any on the valuation date already has effect of any prevailing information. So this is wrong. Statement number 2 is incorrect. Just give me 1 second. This statement is incorrect. Next statement: a debt instrument trading below its face value may still contribute to a lower market value than its book value. Of course, if any security is traded below its face value, then the market value is already less. Correct. Book value will be high because it is on face value. The market value will be lower. This is correct. The stock and debt approach is generally more reliable when the company's securities are actively traded in the liquid public market. True. Stock and debt method anyhow says that take effect of stock and debt, but which is over on the market. According to the efficient market hypothesis, publicly available information is rapidly reflected in security prices. Yes, this is what we discussed in point number 2. This is correct. So 2 is not correct. So wherever you're finding 2, get rid of it. So option number A is the correct answer. And the first one to give me this answer was... Nobody has given me the answer, so I'll take the money for myself then. Yes, this is what I should do. Everybody, please participate. Only then you will be able to apply your brain right here. If you're not participating, you are actually not feeding the correct information to your brain, which is not right. What is the whole purpose of the marathon if you're not doing it, right? Next. A real estate investment trust, that is the REIT, planned to acquire a mid-sized commercial property developer operating across multiple Indian cities. Okay, the valuation team decided to use the direct comparison approach. Direct comparison approach. Do you remember what we did in the class? There's a direct comparison with a similar asset. Some other company, similar asset. Because several listed developers with similar projects, see, similar project profile, debt structure and geographic exposure were actively traded in the market. During the valuation process, disagreements emerged regarding the selection of comparable companies, treatment of intangible asset, interpretation of industrial multiples, and to the extent to which growth expectations should influence valuation adjustment. Okay, of course there will be a disagreement. One analyst argued that the selected peer group was inappropriate because some comparable firms operated in luxury housing, while the target company focused primarily on affordable commercial spaces. Another analyst warned that the market-wide optimism in the real estate sector should distort valuation multiples and lead to overvaluation if not carefully interpreted. Which of the following statements regarding the direct comparison approach are correct? The principle of substitution forms the conceptual foundation to the direct comparison approach. The principle of substitution. Do you think this is correct? Yes, correct. If not mine, then something similar to mine, right? This is correct. This is 100% correct. Time adjustment should generally be carried out after all physical and locational adjustment have been completed. Wrong. Time adjustment is to take place at every aspect of it. So wrong. Comparable companies selected for valuation must necessarily be identical in all operational and financial characteristics. Do you think this is correct? No, we cannot be identical. We can only be similar. We cannot be identical. I cannot find somebody who has exact match of what I have. That is not possible. Something similar to me will also work. Necessarily, they should not be identical. They should be similar. Peg ratios are something used to account for differences in expected growth rates among companies. PEG ratio. Do you remember what was PEG ratio? Correct. PEG ratios adjust the pre-earnings. That before this, what was my pre-earnings of the price-earning ratio? By expected growth rates. Right? So it is correct. Next. Multiple regression analysis may be used to statistically control differences among comparable firms. Read it again. Multiple regression analysis may be used, that they can be used, right? To statistically control the differences among comparable companies. Correct, correct. Multiple regression techniques are used. And statistically, you will have to analyze it, right? So you can use and how fundamentally it is affecting my two companies or multiple domains of the company. So it is correct. The direct comparison approach completely eliminates subjective judgment. No, subjective judgment is there. I have to judge it, which asset is similar to mine, which company is similar to mine. So wrong. Market-wide overvaluation within a sector can influence multiples using comparable company valuation. Correct. If there might be an overvaluation, then that might influence my valuation as well. So 2, 3 and 6 are not correct. Wherever you can find 2, 3 or 6, get rid of it. So A is the correct answer. A is the correct answer. Oh, sorry, 5 was correct. 1 is correct. 4 is correct. 5 is correct. 7 is correct. So 1, 4, 5, 7. So A is the correct answer. Right. 3 is not correct. Correct. Okay. So who was able to get the correct answer? None of you. Again, I'm saying, if you will not participate, how will you solve it in your exam? The question is same, everybody. It is your future we are talking about. Okay. Next question then. A is the correct answer. 1 is correct. 2 is incorrect. 3 is incorrect. 4 is correct. 5 is correct. And 7. So 1, 4, 5 and 7 should be the correct answer. 1, 4, 5, 7. Yes, A is the correct answer. Next question. A valuation analyst is estimating the value of an unlisted manufacturing company using the direct comparison approach. 3 listed companies are given to me in the same sector are identified. Their EV to EBIT multiples are as follows. So EV upon EBIT, they have given you as 8x, 10x and 12x. The analysts decide to assign weights based on similarity to the target company. Okay. Company P is 20%, Q 50% and R is 30%. So what is more similar to me? Q, right? The target company's EBIT is estimated at 48 crores. Okay. The target company has 48 crores. The company also has outstanding debt of 110 crores and excess cash of 20 CR. Okay. Based on the above information, which of the following statements are correct? The weighted average EV upon EBIT multiple is 10.2x. Do you think this is correct? Let's calculate it. बहुत easy hai. It is very, very easy. Let's calculate it. So my weighted average EV upon EBIT will be every similar company. We have chosen 3 similar companies, right? So take every similar company, multiply it with its weightage, because I am trying to calculate the weighted average, right? That is why they have given you the weights in the question. They have given you the weights in the question, right? 20, 50, 30. So if I have to calculate the weighted average, it will be 20%. I can write it as 0.2 into 8 plus 0.10 or 0.50 into 10 plus 0.30 into 12. This should be my weighted average EV/EBIT, which will be around 4 1.6 plus 5 plus 3.6. So 10.2x. Correct. So this statement is 100% correct. Correct. The estimated EV enterprise value of the target company is 489.6 CR. Can I calculate this? Calculate कर लेते हैं. EV कितना होता है? Understand this. EV is equals to, the basic formula is EV is equals to EBIT into its multiplier. Right? Now my EBIT is given to me as 48 CR. And the multiplier that I will use it, we have just calculated the weighted average. We have just calculated it. Right? So into 10.2. Which will be how much? Which will be how much? 48 into 10.2. So 489. Correct. So this is also correct. Are you all doing it with me? Are you all doing? I will not solve the question until unless I know that you all are with me and participating. If you're not participating, there is no point. I already know the answers. I have the whole information with me. You are somebody who has to solve the questions, right? So let's do it together. I want answers from you, everybody. Please. No point if you are not doing it with me. Okay. Moving ahead. The EV, the equity value of the company is 390 CR. How do I calculate this? This is a bit tricky here. Now, equity value is what? Your enterprise value minus your debt plus your cash. Okay. Understand one thing. I know that my enterprise value, the whole enterprise value is equity plus debt plus other obligations minus cash reserves. Right? My enterprise value, the estimated enterprise value is given to me as 489.6. Equity, I don't know. Debt, do I know? Debt, do I know? They have not given us debt anywhere, right? Let's assume it was 0. Other obligations was not there. But there is cash given in the question. Achha, outstanding debt is also 110. 110. And the cash that is given to me is 20. So, can I find out the value of 20? Yes. 489 minus 110 plus 20. Very simple, right? 489. Oh, sorry. The enterprise value 489.6 minus 110 plus 20.6, right? Minus 110 plus 20, which will come to how much? Please tell me in the comment box what is the correct answer. This is not correct. Because 489 plus 20 will be 500. This is not correct. This is not correct. It should be 399.6. 399.6. So this is not correct. If a simple arithmetic average had been used instead of weighted average, if I have not assigned the weights, मैं हटा दूंगी. Let me get rid of the weights, and I would have simply taken an arithmetic average. That is 8 plus 10 plus 12. The enterprise value would remain unchanged. Do you think that will happen? Do you think that will happen? 8 plus 10 plus 12 divided by 3, 10. And right now the multiplier is 10.2. So the enterprise value would have changed. Right? So it will not remain unchanged. So this is also wrong. Increasing the weight of company R would increase the estimated enterprise value. If weight of company R is increased, and company R has the highest multiple also, right? If I increase its weight, and definitely 110%, because it has highest multiple, that is 12x, and I've increased the weight also there, 100% my EV will also increase. 100% it will increase. So this is correct. If you do not believe me, let's do it. You can make this as 40 and make this as make this as 30 and make this as 50. You'll see the answer will be more than 10.2. 100% I can tell you that. Enterprise value is adjusted for debt and cash to derive equity value. If I adjust debt and cash from enterprise value, will it give me equity? Do you think that is correct? Yes. Debt is deducted and excess cash is added back to derive equity value. Yes. Now my EV takes care of all the things. It should have equity, it should have debt, it should have other obligation. Debt is deducted and excess cash is added back to derive equity value, right? This we have just done. If I have to find out the equity value, I will have to deduct the debt and I have to add back the cash. So yes. If the target company's EBIT is 25%, okay, keeping the same weighted multiple, the multiple should be 10.2 only, and the new EBIT is increased by 25%, okay, so 48 plus 25%, the new value will be 600 crores. Do you think this is correct? 48 plus 25%, 60, 60 into 10, 60 into 10, which will be 600 crores. It will be 600 CR. Right? So 1 is correct, 2 is correct, but it will be, sorry, I have to multiply my 48 plus 25% into 10.2. So if I would have multiplied it by 10, then 600 would have been there. But into 10 by 2, 10.2, this is not correct. And enterprise value is adjusted for debt and cash to derive equity value. You have to see the statement here is haywire, honestly, if you ask me. But I have to adjust my debt and cash to come to equity value. So that is why I have said that this is correct. But the statement could have been better. So 1 is correct, 2 is correct, 5 is correct, and 6 is correct. 1, 2, 5, 6. So D is the correct answer. D is the correct answer. D is the correct answer. Were you all able to do it with me? My question is very simple. Were you all able to do it with me or not? If you were not able to do it with me, I can repeat it for you. These are good question, important question. Anyhow, ABFM exam is full of logical explanation. It was very hard the last term. You know that this exam was so difficult last time. We have to prepare accordingly this time as well. Were you able to do it with me? Please give me some answer. I need some answers from you all. Were you able to do it with me? Okay. One thing for sure, I am not moving ahead until unless I get some answers from you all. Because I'm not doing this for me, I'm doing this for you. If I'm getting answers only, then I'm moving ahead. Otherwise, I'm not moving ahead. Shruti ma'am, Pushpa Kumari ma'am, Ramesh Kari sir, Rani ma'am, are you able to do it? People over YouTube, are you able to do the questions? Do you need any other explanation? Do let me know in the chat box, please. Okay. Okay, then let's move ahead. Next, it is the correct answer. Yes, I've given you the correct information for all the questions. Next, a manufacturing company, Orient Components Limited, is evaluating 2 expansion proposals involving automation and export-oriented production. The finance team prepared projected free cash flows for next 10 years. Okay, so if this is 0 period, that is today, I have calculated the cash flows for next 10 years. Projected. Because on the basis of estimations, we have done it. and use the company's weighted average cost of capital to estimate the present value of both projects. So we have calculated the present values, we have discounted the future cash flows, and we have come and the discounting factor is back the weighted average of company capital. Okay, we have done this for all the years. Right. So we will be able to find out the present value for both the projects. Okay. 100% correct. This is my time watching this. Okay. Okay, ma'am, no problem. One proposal generates lower cash flows initially, but significantly higher terminal value due to long-term scalability. Okay. The management is also debating whether the forecast period should be limited to 7 years or whether continuing value should be separated estimate beyond the explicit forecast horizon. During the discussion, one executive argued that the future cash flow should not be discounted because inflation will naturally increase the revenue over time. Which of the following statements related to DCF are correct? Now, what is DCF? Before I take you to the options, let me give you a quick reminder of what is DCF. What is DCF? DCF is discounted cash flows, that I have projected future cash flows that I'll get this amount in the coming future. I know for sure that today's 100 rupees is more than 100 rupees tomorrow. This we all agree with because of time value of money. If I have 100 rupees in my pocket today, and if I have same 100 rupees in my pocket after 1 year, then I am poorer than who I am today. How? Because today's 100 rupees will fetch me more items as compared to 100 rupees in the after 1 year or after 2 years, after 3 years, so on, because of decreasing value of money over time. Right? If not invested, the value of money is always decreasing. Any money which is not invested is the value is decreasing because of time value of money. Now, this is discounted cash flow, that whatever money is there in the future, you have to bring it back to today's current value. That if tomorrow you are getting 100 rupees, what is its value today? 1000%, 100 rupees after 1 year will have lower value today. So whatever I can buy in 95 rupees today, I will be able to buy the same thing with 100 rupees after 1 year. So today's 95 is equivalent to 100 after 1 year. Just for an example, I've taken these numbers. So this is discounted cash flow. The present value will be lower as compared to the future value. In amount. Right? In numbers, the value will be lower because market value today of 100 is more than the market value of today of 100 after 1 year. Right? So this is all about discounted cash flow. Now let's read all the points and see which of the following are correct. DCF valuation is based on the principle that money available today is worth more than the same amount received in the future. 100% correct. In DCF analysis, the discount rate generally reflects the cost of capital or required rate of return. Now I will have to discount it. I am using the formula that future rate is equals to present value into 1 plus R upon keep R n. Right? Meaning that whatever the value is today, add inflation rate to it. Right? So if I have to calculate present value, then it will be future value. Oh, sorry. Something has happened. Okay. Future value divided by 1 plus R divided by keep R n. Right? So they are saying that this R, the rate via which you will discount it, it will be either the cost of capital or required rate of return. This is also correct. This is also 100% correct. Okay, next they are saying is the terminal value is ignored in firm valuation wherever the explicit forecast period exceeds 5 years. They've never said that. What is terminal value? One value that after that the amounts are increasing at the stable growth rate. We are saying that after 10 years, for example, after 10 years, there will be future cash flows, but at a similar rate for all the coming years. right? Similar amount for all the coming years. So this is my terminal value, that after this the earnings will stabilize. Now let's say my earnings today were 10 lakhs. After 2 years it will be 12. After 3 years it will be 15. So after that it will be 20. So do you think the growth rate is different every year? Here the growth rate was 12 minus 10 divided by 10. Here the growth rate was 15 minus 12 divided by 12. Here the growth rate was 20 minus 15 divided by 15. Right? So the growth rate is changing every year. But after the 10th year, I know that the growth rate will be same. Every year I will get, let's say, 100 CR. Every year, 11th year also I'm getting it, 12th year also I'm getting it, 13th year, every year same amount with or similar growth rate. That for after 10 years, 11th year I'm getting 100 CR, 11th year 110 CR, 12th year 120 CR, 130 CR, 140 CR. The growth rate is same. Making sense? Then this is terminal value. They are saying that don't take effect of terminal value if the projections are over 5 years. This is wrong. This is wrong. We have never said that. DCF methodology for valuing a business differs from typical capital budgeting project because the business is generally assumed to continue and grow indefinitely. They are saying for capital budgeting, you take a limited time period. But for DCF, we take forever because going concern is there. Going concern assumption will take place, right? So yes, this is correct. This is correct. In capital project, there is a finite life, limited time. But for business, the life is infinite. Last, a higher discount rate. Keeping future cash flow constant, generally increasing the present value of the firm. Do you think that is? If the discount rate is high, the present value will be lower. This is wrong. This is wrong. So only 1, 2 and 4 are correct. So A is the correct answer. A is the correct answer. What do you think? Are you able to do it? Are you able to do it? Is this making sense to you all? Okay, next question then. A missized manufacturing company XYZ Component Limited is evaluating a strategic acquisition opportunity in the industrial automation sector. Okay. The management hires a valuation consultant to determine the intrinsic enterprise value. What is enterprise value? Value of the equity plus debt plus other obligation minus cash flows. Minus cash and cash reserves, right? Using the discounted cash flow approach. Okay, instead of EV approach, I am finding out using discounted cash flow approach. That is, I'm trying to discount all future earnings. Okay. During discussion, disagreements emerged regarding the treatment of excess cash balance. Oh my God, what is to be done now? And there is a disagreement regarding the terminal value assumption as well. Operating margins for high growth division and the use of market versus book value weights in WACC. The analyst also debate whether certain investments yielding returns below the capital of below the cost of capital should continue to remain part of business model based on the concepts relating to DCF. Which of the followings are correct? See, DCF is very important anyhow because you have one different unit over it. Unit number 14 is DCF only. So let's put in efforts in DCF. They will ask you questions for DCF 1000%. I can write it down and give it to you. While computing operating invested capital, that how much capital have I invested which is used for operations, right? Excess cash and marketable securities are generally excluded from operating market capital assets. Working capital assets. Do you think this is correct? Do you think this is correct? Yes. Whenever I'm trying to find out that how much portion of my capital is used in operations only. See, when there is a business, in this business, the core of any business is selling a product, right? Sales is the core of any business. Take any business. Sales is the core of it. Either the business will sell products or it will sell services, right? You agree with me over here, right? But apart from sales, there will be other involvements. There will be other aspects of the business. Like this business must be investing somewhere into marketable securities, right? There might be some income from some rent, from some interest income might be there. There could be some commission income. There could be n number of other incomes apart from the main business, which is sales, right? You agree with me here, right? So if I have to calculate my operating invested capital, that how much capital is used for operations, especially if I have to buy capital assets from my capital, from the capital that I've invested, how much of capital assets which are used for operations are bought. Simple meaning, simple English, right? They are saying that all sort of cash, excess cash, and all sort of marketable securities should be excluded. Correct. This statement is correct. All sort of excess cash and all sort of marketable securities should not be taken into operating investment, right? Because they are treated as what? Non-operating assets. These are non-operating assets. Cash is not used into operations. If it is excess, then right now you're not using it. If it is a marketable security, you have not put my money for operations. This money is spent somewhere else. So this capital, it should not be included in my operating invested capital. Making sense? So yes, statement number 1 is correct. For operating invested capital, all sort of cash, you're not using the cash for operations. Marketable securities, you're not using them for operations. Just get rid of it. If there is an operating working capital asset, get rid of these two from them. No plat, that is profit after taking impact of tax, right? Considering the tax shield arising from interest expense, because the interest is deducted while calculating EBIT. They are saying that in no plat, the statement is so wrong at so many levels, I cannot tell you why. Wait. They are saying that whenever I calculate my no plat, what I do is I take care of my tax shield without deducting interest. Without deducting interest, you take care of your tax shield, right? So this statement is wrong. Whenever I'm calculating no plat, I always do this EBIT into 1 minus T, and then the formula is continued. So you are not deducting I from EBIT. You are taking away the tax shield before the tax expense. So this is wrong. This is wrong. ROIC, that is return on the invested capital, becomes conceptually inconsistent if the assets included in invested capital do not correspond with the income included in the no plat. If the income is not included in no plat and in ROIC you are including it, do you think the no plat will be correct? No. So the given statement is correct. The given statement is correct. There should be a consistency in the numerator and denominator, right? The numerator and denominator should be in alignment with each other. If you are not taking that particular income or that particular income from that asset in no plat, then it should not be taken into ROIC as well. So this is correct. Statement number 3 is correct. Any doubt here? Please ask. Net investment may alternatively determined through year-to-year change in net fixed assets and net current assets. They are saying that if I cannot find my net investment directly, then I can calculate it by using what is the change in current assets and fixed assets. Correct. This is also correct. Just 1 second. This is also correct. Free cash flow to all providers of capital can be obtained by deducting net investment from NOPLAT. That if I have calculated your NOPLAT, just deduct net investments from it and you will be able to find out FCF, that is free cash flow. Then adding non-operating cash flows. Do you think that is correct? Do you think that is correct? Yes. Because the formula for FCF is nothing but NOPLAT minus net investments and plus your non-operating cash flows. So this is correct. Next. VAT should ideally be computed using book value weights. No. VAT should be taken by taking market value, fair market. So this is wrong. In DCF valuation, both free cash flow and VAT are generally expressed in nominal post-tax terms. Correct. Both the things. Free cash flow is also, because NOPLAT is after taxes and VAT is also after taxes. This is also correct. 8. Under the growing perpetuity method, terminal value can be estimated only if the perpetual growth rate exceeds the WACC. No, the perpetual growth rate has to be stable. It should be same for each year. We are never saying that it should be more than WACC. Wrong. It should have. This is unrealistic if I say that. This is wrong. A project earning less than the cost of capital should always be liquidated immediately. How can that be correct? Irrespective of continuing value, salvage value or divestiture value. Wrong. You have to take care of other things as well. Wrong. So only 1 is correct, 3 is correct, 4, 5, 7 are correct. So A is the correct answer. 1, 3, 4, 5 and 7. Correct. So A is the correct answer. I hope you all are able to do it. Should I move forward? Do you need me to continue? Do you want me to repeat anything? Please do let me know. Do you want me to repeat anything? This is important. This particular question was very good. They could have very easily asked you this question for exams. This is a good question. Okay, next. Just give me 1 minute, everybody, please. Okay. First point, why excluding operating working capital, ma'am? It includes an operation. We are not excluding operating working capital. We are excluding from working capital. Read the line again, Pushpa Kumari ma'am. The question is that you will deduct excluded from operating working capital assets. That you will take working capital assets that are also included in working capital. You subtract these two, excess cash and marketable securities, from operating working capital assets. Making sense now? Okay. Moving ahead. Next question. Okay, great, Pushpa Kumari ma'am. Next question I have for you. Yes, A is the correct answer. Omega Infrastructure Limited is being valued by DCF. Now let's do the numerical as well. EBIT is 720, tax rate is 30%. I had to deduct it. Yes. Net investment during the year is 180. WACC is 11%. Expected cash flow next year 420 lakhs. Long-term growth rate 5%. Present value factor terminal value is 0.650. Okay. No plat of the company is 504 lakhs. Let's calculate no plat. Let's calculate no plat. What is the formula for no plat? No plat is nothing but EBIT into 1 minus T. है ना? So EBIT into 1 minus T. So which is 720 into 1 minus 0.30. Which will be how much? Which will be how much? Please calculate 720 into 1 minus 0.30. That is 720 into 0.70. 720.7. Around 500. It will be 504. Correct. No plat of the company is 504. This is correct. It will be 720 into 0.7, 7749 and 2 here. So 504. Correct. Absolutely right. Free cash flow for the current year is 324. We can calculate it also. This is no plat. The formula for this is this. For free cash flow, I know I have to take no plat into account. And what else is to be taken into account? Net investments. So you subtract net investments from it. What are my net investments? Net investment for current year is 180. If they would have given me other information, I would have added non-operating cash flow also to it, right? If that would have been there. So no plat is 504 minus 180, which will be how much? Please calculate it. 404 minus 180 will be 324. This is correct. Terminal value at the end of the explicit forecast period is 7,000 lakh rupees. Oh my god. Do you think this is correct? Let's calculate it. I know present value is equals to future value divided by 1 plus r power n, right? And if I know, I don't know the future value, I don't know the r for it, and I don't know the n. My concern in this question is I don't know what is my time period, right? I don't know what is my time period. Nowhere they have mentioned that these many years will be used. So what do we do is, I know that my PO is equals to D1 upon KE minus G. This formula I told you, remember, for life. Also known as growth, dividend growth model, right? Just remember this formula, that price today will be equal to dividend for next year, immediately next year, divided by your required rate of return minus your growth rate. If I substitute it to present value formula, so present value will be equals to future value divided by WACC. KE will be substituted with WACC because WACC is given in the question. If WACC was not given in the question and KE was given to me, I would have taken KE minus growth. Same formulas. So rather than thinking of 10 formulas, let's keep just one formula in mind. Let's solve it. I know the expected free cash flow next year, immediately next year, D1, year from today. If P is today, P0 price today, so I have to take D1, dividend next year, which will be 420 divided by, what is my WACC? My WACC is given to me as 11%, so 0.11, minus what is my growth rate? Long-term growth rate is 0.05 because 5% is 0.5, right? So 420 divided by 0.11 minus 0.05. Should I tell you the calculator usage, or you remember it with when we did it in class? I hope you do remember. It is very easy. What you do is you calculate 0.11 minus 0.05, 0.11 minus 0.05, Put it into divide equals to, it will automatically come into the denominator, and you write 420. You write 420, multiply 420, and you will get your answer. Just write 0.11 minus 0.05. You will get the answer for this. Take it into the denominator. How do you take it into the denominator in the calculator? You press divide equals to. Divide equals to. It will automatically go to the denominator. Multiply it with 420. Press equals to. You will get the answer. You will get the answer, which will be how much? Which will be equal to 7,000 only. So this is also correct. So this is also correct. Present value of terminal value is 4550. Let's calculate it. If this is my terminal value and this is the factor, present value factor for terminal value, so it will be 7,000 into 0.650, which will be 4550. Correct. If the perpetual growth rate becomes equal to WACC, if the perpetual growth rate, that the growth rate is same as equal to WACC, which is 11%, the perpetuity valuation model may produce an indeterminate or undervalued, unrealistic amount. Correct. This is unrealistic because WACC minus G, that is 11 minus 11, will be 0. So fair value divided by 0. Can I find this? This is not, you cannot find anything if there is anything in the denominator. The answer will be indefinite. The answer will be indefinite. So this is also correct. So all are correct. So C is the correct answer. C is the correct answer. C is the correct answer. I hope you were able to do the question. You will get such questions in exam. You will never get a question to full-fledged solve the numerical, never. But you will get such questions where you will have to find out the values at each step. I hope you all are able to do it. Any question? Ask. This was the last question for this unit. We'll move to the next unit now. If you have any sort of questions, please ask me. This is the time where you ask questions. Any question, anybody, this is your time. Ask questions. Okay, let's move to the next unit then. The next unit is nothing but DCF only. That is why I did spend a lot of time here itself for explaining you how DCF works. Now let's do the questions directly for DCF. Let's take a quick 6 minutes recess. Let's start at 7 p.m. exactly. Okay. Okay, everybody, I hope you all are back. Okay, just give me 1 second. Okay, I'm hoping you all are back from the break. Let's do the next question then. Next unit, I'll give you a quick recap of how the unit works. It is one of the most important numerical chapter. DPS is nothing but the present value of future cash flows. I know that 100 rupees today will definitely hold more value than 100 rupees tomorrow, next year that is. The reasons is because of the investment opportunities, inflation and risk, important for MCQ. Now, the formula that you'll use is future value divided by 1 plus r power n. Now, n could be anything. N is time period. Understand that n is nothing but time period. Okay, so the time period could be less than 1 as well. But how do I know that? That depends on r. What sort of r you have gotten. If this r is per month and 3 months are there into consideration, so it will be future value divided by 1 plus r per month you have got is, let's say, 6%. So 0.06 power 3, because n I have told you is n period. I have not said years. When because this is what is written into theory and they have said years, but n is never the years but the time period. Always remember that. Now, how do I find out my DCF? Estimate the future cash flows. Step number 1 should be, in DCF the question is a bit more difficult. What they ask you? They ask you to calculate all future cash flows yourself. Determine the WACC also. Then calculate the terminal value. That is, let's say for initial 3 years, 1, 2, 3, the growth rate is different. And after the 3rd year, from 4th year, let's say 4th year onwards, the growth rate is stable. So first 4 years the growth rate is different. So this has G1, G2, G3 and G4. And from 4th year ahead, it is G5 for all the years. Every year has same growth rate. So year 4 is your terminal year. So I have to calculate my terminal value here. How will I calculate that? How do I calculate the terminal value? The terminal value will be very simple. P4, because I have to calculate the 4th year price, will be equal to dividend of the 5th year, cash flow of the 5th year, divided by your KE minus G. That is WACC minus G. Rate minus G. So if I calculate this P4, I have to just find out the present value of this. I have to just find out the present value of this, present value of this, present value of this, and present value of this. Right? So one step we have increased. Calculate the terminal value, for which you'll use this basic formula which I've told you. Discount all the flows and add all the present values. Add all of them, 1, 2, 3, 4, and you will have your answer. Now, free cash flow, a direct formula for free cash flow via EBIT. This is no plat plus depreciation minus capex, any sort of capital expenditure that you have done, and plus minus any change in working capital. You remember working capital, CACL? Any change in that, you will do it. Now, FCFF belongs to the entire firm. So this free cash flow to the firm, and free cash flow, when we calculated FCF, that was no plat minus net investments plus non-operating cash flows. Remember this plus minus. This was free cash flow. This was for equity. But now we are talking about the whole firm. Free cash flow for the firm. The whole firm. It belongs to the entire firm. The formula is different. That is why plus depreciation minus capex minus any plus minus changes in your working capital. Okay, and it is not just for equity shareholders, it is for the entire firms. Free cash flows were only for equity shareholders. That is why I'm not using that formula here, right? Now, so the first dividend distribution model, dividend discount, also you can call it P0 equals to D1 divided by K minus G. Same that we have done, same formula that I have told you, where price today will be equal to dividend tomorrow, dividend after 1 year. If the dividend, important language of the question could be dividend just distributed. If the dividend is just distributed, then this dividend is for today, for this year. Then it will be D0 and not D1. D1 can be written as D0, that is dividend for this year, into 1 plus G divided by KE minus G. The whole formula is this, honestly. Today's dividend plus the growth rate, that is into 1 plus G divided by KE minus G. This is the exact formula. So if the question says that you have just declared the dividend, then this is for this year. Just declared or just distributed this year, D0. Dividend might be declared for next year, D1. Understand, the question, the answer will change drastically. D0, D1, two different things. Dividend next year, cost of equity divided by and growth rate. Very important numerical. Now let's do the questions. Let's do the question. Are all of you ready for questions? Are you all any doubt till here? Please ask. If you have any doubt, unit 1 or this unit, any doubt, please ask. If you have any sort of doubt, this is the time where you ask questions, all of you. If you're not asked questions, nobody can help you, honestly. Rani ma'am, Albin sir, Raja sir, Pushpa Kumari ma'am, Kuti sir, any doubt still here? Do ask the question. Okay. So, question number 1. A rapidly growing infrastructure analytics company, Vistra, is being evaluated by a private equity fund using DCF. The company currently operates in smart urban infrastructure projects and has a revenue growth of 25% annually. So G is given to you as 25%. It is stable. Now, one important thing that you should keep in mind, this formula can only be used with if G is stable. G is stable. That is, G is fixed. Or if the growth rate is increasing at a same rate. That first year if G was 10%, second year G was 12%, third year G was 13%. Can you use this formula? No. Then what G will you take? You cannot use it directly. Every year you have to calculate different PO then. Every year then you have to change your G. Every calculation will have a different G. This formula you can only use if you have a same perpetual stable G. Then you get basic answer. For long term. If I have to calculate just for 1 year, then okay, fine. G can be changed every year. But for long term terminal value, this can only be used if G is stable. I hope that is making sense to all of you. If there are different G's, then you have to calculate different POs as well. Okay, next. For the last 4 years. Okay, that is, if this is 0 period, for last 4 years, 1, 2, 3, 4, it will be 24%. So I can calculate my terminal value over here. Right? A large portion of its growth comes from exclusive municipal technology license that are expected to expire in 6 years. So initial 6 years, 1, 2, 3, 4, 5, 6. The growth rate is different. 7, 8, 9, 10. The growth rate is different. The valuation team faces several challenges. The management projects aggressive cash flows, while external analyst expects growth moderation due to increasing competition. The company has recently financed expansion through a mix of equity and long-term debt. The valuation analysts are debating whether to rely on FCFE, that is free cash flow for equity, or FCFF models, free cash flow for the whole firm model. With what discount rate assumption should be used, and whether the firm should be valued using a stable growth or a two-stage or a multi-stage model. Two-stage model, initially the growth rates were different and then the growth rate was different. Let's say initially the growth rate was 30%, then it was at 24%. This is two-stage. But if every year the growth rate was different and after that it stabilized, then this is multi-stage. This is multi-stage. G1 was different, G2 was different, G3 was different, and G was different. This is known as two-stage. This is known as multi-stage. Okay. They also disagree on whether market value or book value capital structure weight should be applied while computing the weighted average cost of capital. Which of the following statement regarding DCF input and growth estimations are correct? Free cash flow to firm represent cash flows available to all claims holder after accounting for operating needs and reinvestment requirements. I have taken care of reinvestment also. I have taken care of operating needs also. Now, whatever is left for everybody. That is free cash flow for the whole firm. Do you think this statement is correct? Do you think this statement is correct? Well, yes. The given statement is correct because while calculating FCFF, you have taken care of all operations, that is your expenses, tax, this, that, and if whatever you wanted to reinvest into the company, you have done that as well. Now, whatever is left, that is for the whole firm, for all sort of equity holders, all sort of claim holders, equity, debenture, debt, everything. So, this given statement is correct. In valuation, the discount rate applied to cash flow. Just 1 second. In valuation, the discount rate applied to cash flow should increase as the riskness of those cash flow increases. They are saying that you should increase the discount rate since the risk is increasing. If higher the risk, the discount rate should also be higher. Correct. One basic rule: higher the risk, higher the discounting rate. Because if the discounting rate is high, the present value is low. So you can write it down if you would like to. See, higher the risk, higher the discounting rate. Higher the discounting rate, lower the present value. Always remember that. Lower the risk, lower the discounting rate. Lower the discounting rate, higher the present value. Always remember that. If I have no risk, then why should I take higher discounting rate? I should take lower discounting rate, right? If the discounting rate is low, then the present value is high. So this is correct. This is also correct. Book value rates are generally preferred over market value rates because they are less volatile and more objective. Do you think this is correct? Do you think this is correct? Incorrect. You have to take care of what the market is providing. That is the fair value. So this is incorrect. Book value is never to be taken. Fair value always, which is market value. Stable growth rate valuation, that the growth rate is stable, are generally most suitable for firms growing significantly faster than nominal growth rate of the economy. Do you think this is correct? Wrong. If there is a stable growth rate, then they are more appropriate for firms that are already growing at a rate which is below the nominal growth rate or at nominal growth rate. Whatever is the growth rate for the whole industry. If my growth rate is stable, you will always find out it is either as similar to nominal or below that, never above it. Never above it. So this is wrong. Historical growth rates may not always be reliable indicators. Correct. Because historical growth rates are not giving you the exact picture. Correct. Next. Companies enjoying competitive advantage arising from legal barriers such as patents may experience an abrupt reduction in growth after those advantages expire. Yes. For example, Samsung was the first person to bring these phones into the market, the curved edges, right? If you remember when the Samsung first phones came out with the curved edges, they were very expensive. But in today's world, every other company is offering you these curved edges and the prices are very low. Why? Because that patent expired 10 years, after 10 years. So these curved cell phones actually came out around 2014, and by 2024 that patent expired and everybody in the market got the edge there, right? So that is why there was a decrease in the growth rate for Samsung. This is also correct. So the cost of equity generally incorporates compensation for non-diversifiable market risk rather than total firm specific risk. This is also correct, because in cost of equity we are focusing on flexible or non-diversifiable systematic market risk, right? Not for the whole not any firm specific risk. We are taking something which is out of control. So this is also correct. So only 3 and 4 are not correct. So wherever you can find 3 and 4, get rid of it. A is the correct answer. A is the correct answer. Were you all able to do the question? This is a good question. I hope you all are able to do it. Right? Okay. Next question is the correct answer. A diversified manufacturing company is evaluating the acquisition of a rapidly growing renewable energy equipment business. The target company has reported volatile earnings during the last 3 years. Last 3 years, the earnings were volatile. They were changing rapidly due to aggressive expansion, changing debt levels, okay, and fluctuating marking capital requirements. The CFO believes that the valuation model should reflect the company's long-term growth potential and financing structure instead of relying solely on current accounting profits. The investment committee is debating whether the FCFE or FCFF are to be used, a stable growth model or a multi-stage DCF framework is to be used. Okay, they have two confusion whether use FCFE or FCFF, and whether I should use a stable growth model or multi-stage DCF. Some directors also argue that if the business cannot sustain operations because of excessive leverage, liquidation value may become relevant. Now they are thinking that there can be liquidation as well. Which of the following statements using DCF is correct? FCFE valuation is generally more suitable where leverage is stable. That is debt. Leverage is what? Debt. That debt is stable and cash flows are reasonably estimated. Only then you should take FCFE. That is free cash flow available for equity shareholders. Do you think this is correct? Do you think this is correct? Yes. Yes. If my debt is stable, I know every year this is to be given to the debt holders. And I can very reliably count that what are my future cash flows. Only then I should use FEFE. Correct. Otherwise, I will not, if my debt is not stable, I'll not know what is to be given to the debt holders. So, 1 is correct. 1 is 100% correct. A stable growth DSF model is more appropriate when the firm's long-term growth rate is expected to exceed the growth rate of the overall economy indefinitely. Wrong. Wrong. It should be either at the nominal rate or below nominal rate. At the nominal rate or below nominal rate, not higher. Not higher. Wrong. So this is wrong. Next, when current earnings are abnormal or temporarily depressed, normalized earning may provide a more meaningful valuation. Yes. That normally, how do you calculate? Okay, currently we are understanding that there has been a depression or a lot of revaluation. So let's take normalized earnings. Why do you want to take these earnings then? This will not give a true picture. So this is correct. If a firm is excessively burdened with debt and survival is doubtful, equity may sometimes be valued similar to an option of the firm's asset. If the valuation, the sustainability is a doubt now. The survival is a doubt now. Take care. See how much assets you have. So yes, this is also correct. A two-stage or multi-stage valuation model is commonly preferred to firms enjoying higher growth rate that is expected to decline gradually over time. Correct. Correct. G1, G2, G3 is higher, and if G4 is the terminal year, now it is lower. So gradually The G is decreasing, declining. It was 12% initially, came down to 10, came down to 8, and now at 6% forever, perpetually. So it is gradually decreasing. This is also correct. So only 2 is not correct. So wherever you can find 2, get rid of it. C is the correct answer. C is the correct answer. Were you able to do it, all of you? People over YouTube, are things clear to you? I hope it is making sense. Oh, I'm stuck, I guess. Okay, next question. Next question. These are very good questions. I hope you are able to do them. I'm not getting answers from you. That is a problem. Please give answers. Next. A multinational manufacturing company, Zerova Industries, is evaluating a strategic acquisition in the renewable energy sector. The finance team has projected varying future cash flows, that there are various cash flows different for every year under different capital structure. During the board meeting, one consultant recommended valuing the target company by separately estimating the value of tax shield arising from debt financing. Okay. Another advisor suggested that value creation should instead be measured through surplus returns generated over the cost of capital employed. Okay. The management also debated whether dividends or residual equity cash flow should form the basis of shareholder valuation. Okay. Due to the uncertainty in leverage policy after acquisition, the board decided to compare multiple discounted cash flows approach before finalizing the deal. Makes sense. With reference to valuation approach and DCF, which of the following is correct? So two things, valuation and DCF, both the things should be taken into account. The enterprise DCF model, free cash flow to the firm. Enterprise value, always remember enterprise is for the whole firm only. So you will take FCFF. Is generally discounted using the WACC. Do you think that is correct? The enterprise value is generally discounted using WACC. Correct. Enterprise is for the whole firm. So if it is for the whole firm, it has to take care of FCFF only and not FCFE, and it should be discounted using WACC because FCFF belongs to both equity shareholders and debt holders. So yes, this is statement number 1 correct. Statement number 1 absolutely correct. Statement number 2. Under the DDM, that is dividend discount model, expected dividends are discounted using the firm's cost of debt. Remember the formula, PO is equals to D1 upon KE minus G, cost of equity and not cost of debt. Wrong. So, option number 2 is wrong. Option number 3. Option number 3. The adjusted present value model separately recognizes the value of interest tax shield. That how much interest was giving you tax shield arising from leverage. Correct. This is correct. You will take care of interest tax shield for adjusted present value. So this is correct. In the economic profit model, the present value of a discounted economic profit is adjusted by adding currently invested capital. This is also correct. How much you have currently invested in that year. We have already done it in the previous question, right? Free cash flow to equity valuation ignores the impact of capital structure decision on equity valuation. Never. If I have to calculate just for the equity shareholders, I have to take care into account that how much dividend is, how much debt portion is there. So 5 is wrong. 2 is wrong. 5 is wrong. 2 wrong. 5 wrong. So B is the correct answer. B is the correct answer. Are you all able to do the questions with me? Please tell me. Are you all able to do the questions? Any doubt? Ask. This is a good question because this question has all the concepts of the whole chapter, the whole unit. Next. A portfolio manager at an investment advisory firm is evaluating two listed companies for a long-term investment. Company Alpha has consistently increased its dividend by 6% annually for the last 12 years. Okay. So their growth is stable and is expected to maintain the same growth rate in future. So the growth rate is perpetual, right? Company Beta operates in a mature industry and has distributed a fixed dividend per share for several years without any expected growth. If there is no growth, G is 0, then what? The manager is also concerned about how many changes is required. Return and growth assumption may affect the valuation. And which of the following statements regarding the dividend valuation models are correct? Okay. In the constant growth model, that is PO is equals to D1 upon KE minus G, the required rate of return must exceed the growth rate for the valuation to remain meaningful. That KE should be more than G. Only then this will make sense. Do you think that is true? Do you think that is true? Of course, if KE, the R is less than G, then the denominator will become negative. Right? So this formula is meaningful only and only if KE is more than G. If my denominator becomes negative, the answer will be wrong. So this is correct. The given statement is correct. Under the zero growth rate model, that is the second company, the formula there should be, honestly, you don't have to learn a lot of formulas. Only formula I ask you to learn is PO is equals to D1 upon KE minus G. This formula solves everything. If G is 0, will this formula not work? Then also this formula will work. They tell you that the formula is D1 upon KE. Why do I have to learn so many formulas? Let's stick to the basics. Let's stick to the logics. Right? Under the zero growth rate model, G is 0. The intrinsic value of a share behaves similarly to the valuation of a perpetuity. That perpetually, from here till infinity, the valuation will be this. Do you think this is correct? This is also correct. If the dividend remains constant forever, let's say only 5 rupees dividend is distributed no matter what are my earnings, and the growth rate is also 0, then mathematically, if I solve the question till from here till perpetuity forever, the answer will be same, right? There is no growth. D0 equals to D1, which is equals to D2, which is equals to D3, and forever, and R is equals to 0. Oh, sorry, G is equal to 0. So yes, this is correct. This is correct. A higher expected growth rate always reduces the value of a share under the constant growth model. Wrong. It will not always do that. Wrong. The constant growth rate model assuming that dividend grow at a uniform rate indefinitely. Yes. That my G is uniform. It is constant. Correct. If the required rate of return increases while all other variables remain unchanged, only the R is increasing. The value derived under the zero growth rate model decreases. Correct. If my R is increasing, the value will come down. Correct. So 3 is not correct. So wherever you find out 3, get rid of it. C is the correct answer. C is the correct answer. Any question, anybody out here? Please ask. Please ask. Any question, anybody? I would love to hear the answers from you all. Okay, next question. An equity analyst at an investment bank is valuing shares of two companies using dividend discount approach. PO is equals to D1 upon KE minus G. Company Bank Rise is expected to pay a dividend of 8 next year. D1. They have given you D1. And dividends are projected to grow at a constant rate of 5% annually. So constant growth rate model. Investor in the market requires a return of 11% and the risk-free security on risk-free security. So my KE or R is equals to 11%. Another company, Stable Utilities Limited, is expected to continue paying a constant annual dividend. Same dividend will pay always. That is, growth is 0. So D1, right? And investors require 10%. This is R, right? The or KE, you can call it R or KE, anything. Which of the following statements are correct? The intrinsic value of first company under the constant growth rate model is approx 140. Let's calculate. PO is equals to D1 upon KE minus G. D1 is 8. KE is how much? 0.11. G is 0.05. Calculate it, please. 8 divided by 0.11 minus 0.5. What is the correct answer? So it will be 8 divided 0.06, which is 133.33. This is wrong. So the first statement is wrong. It will be 133.33, which is not 140. Next, the required rate for company bank rise increases to 13%. Okay. Now R is changed. This is new R. While the growth remains unchanged, G is same. G is 5% only. The share value will decline. Solve kar lete hain. Let's solve it. 8 divided by 0.15 minus 0.05. Do you think the share value will be now? The share value will be now lower. Do you think that is the case? Solve it. Correct. Because now the denominator has become larger. Denominator बड़ा हो गया है ना, तो आंसर अब कम आएगा. Answer will be lower. Correct. It will be lower than 133.33. The intrinsic value of stable limited share under the zero growth rate is 120. Calculate कर लेते हैं. Let's calculate for that also. PO is equals to D1 upon KE minus G. I'll stick with this formula. D1 is 12. KE is 0.10. G is 0. So 12 divided by 0.10, which will be 12 divided by 0.10, which will be 120. So this is correct. The dividend growth rate of company rises from 5% to 7%. R changed. While all other variables remain unchanged, the intrinsic value of the share will increase. Do you think that is the answer? The denominator has increased now. Sorry, the denominator has decreased now. So it will be 8 divided by 0.11 minus 0.07. So denominator has decreased, which is 0.04. So the growth rate the amount will increase. So correct. Fourth is also correct. Under the zero growth model, doubling the required rate of return would double the intrinsic value. Yes, because G is 0. Wrong. I was just waiting for somebody to call it out. No. Why it be double? No. Intrinsic value will not double. It will increase by that percentage. Not be doubled. So 1 is wrong, 5 is wrong. 1 wrong, 5 wrong. C is the correct answer. C is the correct answer. I hope you all are able to do the questions here. I hope you all are able to do the questions out here. Is there anybody who is unable to do the questions? Very simple calculations, right? Anybody has any doubt? Ask. I'm waiting to ask the question. Don't worry. I'll wait. If you have a doubt, you can ask. Ramesh sir, Divan sir, Chita Gondam, Rani ma'am, any doubt? Please ask. Okay, next question then, if you have no doubts. Okay, next question for you all. A listed manufacturing company experienced rapid earning expansion after requiring a niche robotics firm. Analysts projected that the company would remain a supernormal dividend growth rate for next 6 years. Now, the growth rate is supernormal because of temporary patent. However, after the expiry of the patent and entry of global competitors, the company was expected to stabilize into a mature phase. Now the G will be constant. Initially, the G is very high. Now the G has become constant. Okay, with a lower perpetual growth rate. And equity analysts use a two-stage dividend discount model. Makes sense. Right now, for coming first period, G is very high, and after that it has become stable. So I have G1 and G2. So they have used two-stage model. Okay. While preparing the valuation note, the analyst also discussed assumptions related to discount rates, terminal value, and sensitivity of valuation to changes in growth expectation. Since there is a stable growth rate, so I can find out terminal value and then I can discount it, right? Okay. What of the following statements regarding two-stage discount model are correct? The first stage of model generally captures abnormal or supernormal growth for a finite period, initial 6 years here, before stable growth rate begins. Correct? बिल्कुल सही है. Since initially the growth rate is very high, then it becomes lower and at a mature rate. So this is correct. In the second stage, the terminal value is commonly estimated using a constant growth dividend approach. Yes. P0 is equals to D1 upon KE minus G. Constant rate. So this is also correct. This is also correct. If the perpetual growth rate in the stable stage, exceeds the required rate of return, that is G is more than KE, the valuation model may produce unrealistic or undefined values. Of course, if my KE is 10% and my G is 11%, it will be negative and answer will be wrong. So this is also correct. This is also correct. The two-stage model assumes that the extraordinary growth rate and stable growth rate remains identical. No. Wrong. These are not identical. Wrong. An increase in the required rate of return, holding all else constant, generally reduces the present value, dividends and terminal value. If R is increased, my present value will decrease. I know that. If my R discounting rate will increase, my present value will decrease. This is correct. So only 1 and 2, 3 and 5 other. 4 is incorrect. So wherever you are seeing 4, get rid of it. B is the correct answer. B is the correct answer. I hope you all are able to do these questions. Next question. Should I slow down or should I increase my speed? Do let me know, all of you, please. Do let me know, please. Should I increase my speed or should I slow down for you all? Whatever you will say, we will do that. I'm waiting for your answers in the chat box, please. Okay. Moving ahead. A listed company has experienced rapid earnings expansion over the past few years due to aggressive market penetration and acquisition-led growth. Analysts expect that the company's unusual high growth rate is gradually moderate rather than suddenly decline. Okay. The board is evaluating different equity valuation approaches for a proposed strategic stake sales. One analyst recommends that H model, that is multiple stage, because the transition from high growth rate to stable growth rate appears smooth. That is G1, G2, G3, G4, and then G5 for all the years. This is the terminal year. So G1 is 10, G2 is 8, G3 is 6, G4 is 4, and G5 and onward it is 2% forever. Right? It is gradually decreasing. It is smooth. The transition is smooth. H model should be there. Correct. Another analyst argues that the firm is entering a phase where growth may remain abnormally high for a fixed period before entering with transition period and then eventually stabilize, making a three-stage model. While reviewing the valuation assumption, the finance committee also debates issues relating to payout ratio. Payout ratio is what? If EPS, see, I'll take a fresh page and explain it to you. Let's read the question first, then I'll explain the whole thing so that it is easier for all sort of questions for you. Okay. Changing cost of equity and sensitivity of intrinsic value. Consider the following statement regarding the dividend discount rate. Okay. One thing you should remember here is, which is very important for logical explanation, that whatever the company is earning, I'll take a fresh page over there for you all. Wait. Somebody has raised their hand. Okay, must have been. Okay, now whatever the company is earning, first pay to the outsiders. Pay to Nirmala Sitharaman, pay to the outsiders, you are left with AEA. That is earnings available for equity shareholders, right? Divided by number of shares, outstanding shares. What do you get? You get EPS, earnings per share. That per share you are earning this much. From these earnings, you will divide. You will give some dividend and rest will be retained in the company. So this is your payout ratio. Payout ratio will always affect your dividends, and the rest amount will be retained. So if payout ratio is 60%, retained earnings will be 40%. Oh, I guess it was not. Oh. Yes, sorry, the page was not visible to you all. Yeah, I hope it is visible now. So if the dividend payout ratio is 60%, the retained earnings will be 40%. So payout ratio will determine your dividend. So that is why dividend is calculated over EPS. Always remember that. Now coming back to the question. My PPT is not working. Okay. Question says, in the H model, the extraordinary growth rate declines linearly. That every year it is declining linearly. That is 10, 9, 8, 7, 6. Then it is stable. Right? Over a specific transition period until it reaches a stable rate. So yes, it could be 10, 9, 8, 7, 6. Linearly, I am trying to decrease it and then it is stable. 6% forever. So do you think this is correct? Correct. The given statement is correct. This is what is happening. It is in front of you. Yes. The H model assumes that the payout ratio and the cost of equity may vary significantly during the transition period due to the fluctuating growth rates. No. Why is that? I am saying R will change. I'm not saying that payout ratio will change. Payout ratio depends on the EPS, on how much earnings I have. See, look here. This is dependent on this, which will change my dividend. It is not dependent on G. It is not dependent on my changing G. So this is wrong. conventional two-stage dividend discount model generally assumes a abrupt shift from high to stable. Yes, that initially it was 12%, then it has stabilized at 6%, 4%, whatever, 7%. So yes, abruptly there it has stabilized. Correct. The three-stage model can accommodate different payout ratios and different cost of equity across growth phase. Yes, correct. In dividend discount valuation model, if the required rate of return approaches the perpetual growth rate, the estimated intrinsic value becomes highly sensitive. Correct. So only 2 was not correct. Wherever you're seeing 2, get rid of it. So the correct answer is 1, 3, 4, 5. D. D is the correct answer. D is the correct answer. Anybody who was able to give D as the correct answer? Okay, great. Next question for you all on your computer screens. A fast-growing technology company, JCB, has recently declared. So it is DO. Recently अभी दिया है, DO है ये, D1 नहीं है. Next year D1. Equity analysts believe that the company is currently experiencing a temporary high growth phase due to strong AI-driven demand, but growth is expected to gradually decline. धीरे धीरे कम हो जाएगी over a time before stabilizing. So H model, multi-stage. An investment banker company uses the H model. D0 is 6. See, initial high growth rate 18, stable growth rate itna, required rate of return itna. H is 4 years. The initial high growth rate is 4 years. So I have initial growth rate as 18, and after that it will be at here. At the end of 4th year, it will be 6% perpetual. From here, it will be 6% perpetual. So it is 18 here. 18 will come down to 16 within 4 years. Within 4 years. Very easily, it can happen. 18 will come down to 6 within 4 years. So what is the difference? 18 minus 6, 12 divided by 4. Every year, 3% decrease is happening. So it will happen 15, 12. Oh, okay, 4th year it will be 9 and then 6. But from 5th year onwards, it is what? It is 6% forever. Right? Find the intrinsic value. Very easy. Very easy. First, find the terminal value. You have your DO is 6. 0.0 here it is 6. So D1 will be 6 into 1 plus 0.18. You will get your D1. Then for D2, it will be D1 into 1 plus 0.18 and so on. You can find D1, D2, D3, D4. You can find your terminal value. Bring them back to present value and done. And done. Calculate kar le. So it will be DO, which is today 6 into 1 plus G, which is 1 plus 0.18 divided by R, which is 0.12. The R is given to you as 0.12 minus point. Oh, the growth rate initially was, yes, 18%, right? So I will have to change it. This is 18 and this is 12, I guess. 12 and 18. Let's change it. 12 and 18 and it is done. And it is done. Okay? And then you can very easily do it. This is 0.12. And then you can solve it using this simple formula. using this. Either if you have time and you want to go with logics, always do this, calculate the terminal value and then bring it to present value. If you have no time in exam, just remember this basic formula, which is d0 into 1 plus g divided by 1 minus g plus d0 into h, that is the fourth year, into d0 minus dn divided by r minus dn. That is the difference between both the g's. Difference between both the g's, that is 6%. 12% and 6%, that is 6%. I will change the question for you so that correct information goes to you. Just give me 1 second. Let me change. My initial g will be 12 and my new g will be 6, and your rate of return is 18. Yeah. So I have changed the information out here. If you can do it with logic, very good. I will advise go with logic only. But for people who cannot go with logic, or you feel that you have less time in your hand, go with the formula, which is nothing, just multiplied with h and you will get your answer. You will get your answer, which is 154. Which is 154. Okay. I hope it is making sense to all. I hope it is making sense to all. Are you able to do it, all of you? I've changed the question out here. There was a slight error in the question. I hope you all are able to do it. Okay, next question. A listed manufacturing company, Arvind Precision, has reported stable growth rate for the last 6 years. So, stable growth rate model. Despite generating substantial operation cash flows, the company follows a conservative dividend policy and retains a major portion. RE is high. Its profits for future expansion and contingency reserves. Analysts observing the company argue that the market price appears lower than the expected when valued using traditional DD techniques. At the same time, another company in the same sector had consistently paid very high dividend despite weak internal cash generation. The company frequently raises additional debt and occasionally issues fresh equity to sustain its dividend payout ratio. Investors remain dividend divided regarding whether such valuation methods provide a realistic estimate. Which of the following statements regarding DDM are correct? DDM model may undervalue companies that retain large cash balances despite strong flow generation. They are saying that, come back to this equation, see, they are saying even though your EBIT was high, your EPS was high, your dividend payout ratio was low because you have retained earnings which are high. You have high EBIT, because of that you have high EPS, but you want to retain more. Because of that, your dividend payout ratio is very less. Because of this, your DDM will give you intrinsic value which is lower than what is what should be there. Do you agree with the statement? Yes, because my whole dividend discount model is dependent on D1, right? So if my D1 is lower, because my RE is high, definitely the intrinsic value is low. This is correct. The first statement is correct. Sorry. Yes. Forecasting dividend generally require fewer assumptions than forecasting fewer cash flows, free cash flows. Correct. This is also correct. This is also correct because I have to assume D1. Then what will I do? D0 into 1 plus G. Very easily I can assume it. This is correct. Companies paying dividends significantly higher than internally generated cash flows. They are saying that my EBIT was low, so my EPS was also low, right? But I have very high dividend payout ratio because I am retaining less. In such companies, they may appear overvalued. and the DDM. If my numerator is very high, even though in reality, it should not be that high. So my intrinsic value is high. So yes, this is also correct. DDM assumes that the shareholders have no economic interest in retained cash balances held by company. No. G. The growth rate is dependent on RE into, that is retained earnings, into return on equity. RE, retained earnings, into ROE gives you G. So G has direct impact on DDM, right? So this is wrong. A stable dividend policy may reduce valuation volatility compared to valuation based purely on free cash flow. Correct. Correct. So only 4 is not correct. Wherever you are finding 4, get rid of it. B is the correct answer. B is the correct answer. This was one of the most important units for your whole module. You will find most questions, numerical and theoretical, from this unit. I can write it and give it to you. If you are doing these questions also, you are at a very good position right now. That is the end of our unit 14. Second unit also we have done. Now we have unit 15. Are you all ready? Are you all ready? It has been some 3 hours of us doing the questions now, and we have not 3 but 2 hours 40 minutes approx. We have done good work till here. Let's take a pause. Let's take 5 minutes break, and then let's come back again for unit number 15. Again, a lot of formulas in this unit. A lot of formulas in this unit. So I will advise you, clear your brain, come back again. Let's take a 10-minute break, and then let's come back again. Okay, everybody. Yes, I hope you all are back from your break. Now let's do unit number 15, that is other DC evaluation. Now, whenever DCF is not possible or estimates are very difficult, you are unable to find out what is happening, how you are unable to estimate anything because of the volatility, of course. Most probably G is not available, you are unable to calculate WAC, KE is not available, or the future estimates are impossible or unreliable, then you go with other non-DCF valuations. Any valuation which is other than DCF, then you go with these. So how do we do that? Let's start doing it now. All of you, good evening. Kajal ma'am, let's do it. This is one of the major chapter that we should cover. Okay, unit 15 also for unit 3 for this module. The non-CF, when DCF is difficult, you do it. The first formula that you have to learn from it is PE ratio. Now, important. PE ratio is nothing but MPS divided by EPS. PE ratio is nothing but how much money you are spending in order to earn 1 rupee of the share price. How much money you are ready to spend, that is the market price, to earn every 1 rupee of the company. How much amount you are ready to spend right now so that you can earn 1 rupee of the company. Okay, so PE method says the value will be EPS into PE, because PE का formula क्या है? MPS divided by EPS. So PE into EPS will give you MPS, the market price of the share. Let's say though your EPS is 20 and your PE is 15. So what will be your market price? Market price will be 20 into 15, that is 300. So the basic formula that you have to keep in mind is MPS upon EPS. And how do I remember this formula? PE. E is in the denominator, so EPS is in the denominator. And how much money you are ready to spend today? So MPS is in the numerator. Just remember this. Even if you cannot remember this, you should remember this. Now, EV by IPTA method, it says enterprise value will be equal to IPTA into the multiple. This practically we have done this question, and this you should use frequently used in M&As, merger and acquisition. This question is used. We have already used this formula in the above questions, right? Price to book value question, multiplier, which will be market price divided by book value. Price to book value. So market price to book value, right? Simple to remember. Then asset based valuation is net assets is equals to assets minus liabilities. It is for used only and only for asset heavy businesses and distressed firms. Important for MCQ. They have one question for you all the attempts, that which method ignores future growth? Asset based method. For asset intensive businesses, for example, steel industry which involves a lot of capex, right? Chalo, aaja. Let's move ahead. Let's do the question. A mid-sized manufacturer of precision irrigation system is planning to raise capital through a strategic investor. Okay. An analyst has been assigned to estimate the company's enterprise value available for all, using relative valuation techniques. Relative valuation techniques यानी other than DCF. During the analysis, the analyst observes that some peer companies have significantly higher valuation multiples because of stronger distribution network, superior technology adoption, and more suitable revenue streams. The analyst also notices that the management team of ZenNexus has recently expanded capacity through debt, which has altered the company's leverage profile compared to its peers. While preparing the valuation report, the analyst studies EBIT upon IPTA, EV by sales, and price to book ratios. which of the following statements regarding relative valuation is or are correct? Relative valuation assumes that the comparable firms with similar growth, risk and return should trade at similar valuation multiples. That the valuation multiples for EBITDA should be same for similar firms. Do you think this is correct? Do you think this is correct? Well, the model says that yes, relatively similar firms should have relatively similar multiples. This is correct. This is correct. EV by EBITDA is classified as an enterprise value multiple because it relates the value of the entire firm to operating earnings before non-cash charges. Do you think this is correct? Non-cash charges like depreciation. Do you think this is correct? Yes. Correct. Because you are taking earnings before interest, tax, depreciation and amortization. Non-cash, depreciation, amortization, making it enterprise value multiple. So this is correct. This is correct. Company with stronger competitive advantage and superior returns on invested capital may justifiably trade at higher valuation multiple than peers. If you have higher brand name, you have economies of scales, you have stable cash flow, you have better growth perspective, you have higher return on invested capital, then of course you will have a higher multiple. Correct. This is also correct. Now, price to sales ratio is considered an enterprise valuation multiple because sales belongs to all capital providers. No, they're not equally belonging. No, wrong. Equally थोड़ी आप belong कर सकते हो. No, in the ratio of the capital, right? Relative valuation completely eliminates the need for subjective judgment. No, you cannot do that. Subjective judgment is part of us for valuation. So only 1, 2 and 3 are correct. A is the correct answer. A is the correct answer. I hope you were able to do the question. I hope you were able to do the question. Next question. Next question. A valuation analyst is estimating the enterprise value using the relative valuation approach, that is other than DCF. After analyzing comparable listed companies in the renewable energy equipment sector, the analyst arrives at the following average multiples. The average EV is 8.5, average EV by sales multiple is 2.4, and average EV book value multiple is 1.6. The financial data are given to you, EBITDA is given to you, annual sales are given to you, book value of assets is also given to you. The analyst decides to estimate enterprise value under each multiple and then compute the arithmetic average. Since it was not anywhere written weighted average, the weighted word is not there, then we have to assume that this is arithmetic, right? Basic. Based on the above information, which of the following approximate average enterprise value system is correct? So let's calculate it. Let's calculate it. Let's calculate under each multiple and then take an average of it. We can do it, right? We can do it, right? So let's do that. Let's do that, all of you. Please take out your calculators. Without calculators, it makes no sense. First, let's calculate for EV divided by EBITDA multiple. EV divided by EBITDA, which is, it will be your nothing but EBITDA into EV multiple into your multiple, right? Which will be 8.5 into 120. 120 into 8.5. Which will be how much? Please calculate. It will be 1020. This is the first multiple, right? Second multiple, let's calculate together. EV by sales, which will be again how much? It will be again sales into the multiple. Sales into the multiple. sales into multiple, which is how much? 500 into 2.4, which will come to how much? 1200 CR. So I have 1, I have 2. Let's calculate the third one. And the third one is book value multiple. So book value into 1.6, which will give you how much? 1120. That is the third. So 1 plus 2 plus 3 divided by 3. It will give you the average. It will give you the average, arithmetic average, arithmetic mean, like we did in ABM. Do you remember? So it will be 3340 divided by 3, which will be 113. So D is the correct answer. D is the correct answer. Were you all able to do it or not? Very easy question. I'll say these are free marks. Free marks, very easy to calculate and nothing to remember, honestly. Nothing to remember. Just multiply that particular event with its multiple. That's it. Particular component into the multiplier and you have the EV value. Very simple, right? It is very, very simple. I hope you are able to do it. Any question, anybody, please ask. Right? Now, next question. Next question. A portfolio manager at BlackRock was comparing 3 listed manufacturing companies to identify undervalued investment opportunities. A company A reported exceptionally high earnings due to scale of large land parcel during the year. Company B had stable earnings and dividend payout ratio was 40%. Return on equity was 18%. This will help me. Dividend payout ratio is 40%. From here I can calculate D1, D0 and D1. This is my R or KE, whatever you want to call it. And the cost of equity is 14%. Now return on equity is itna and cost of equity is itna. What should I take? This is a problem. Cost of equity is given to you and return on equity is also given to you. This is ROE and not KE. This is ROE, return on equity. And this is your KE, cost of equity, KE. Company C recently shifted its depreciation policy, which increased its current year EPS without improving operating efficiency. The manager observed that company A has PE of 9. That is, MPS upon EPS is 9. Company B has 24. Company C has 11. Okay. He also noted that the investors in the market were increasingly favoring companies with predictable and sustainable earnings rather than temporary accounting gains. Consider the following statements regarding PE multiple and equity valuation. Equity valuation is exactly same as DDM. PO is equals to D1 upon KE minus G. Can I write this as, okay, now look at this formula. I told you remember just one formula, that PO is equals to D1 upon KE minus G. From here, can I write that KE minus G is equals to D1 upon PO? I can write it like, right? So KE can be D1 upon PO plus G. Can I write it like this? Of course, the formula is correct. So equity valuation is nothing but this. This is the formula that you use for equity valuation. So you do not have to learn 10 formulas. Please stick to one and you will have your answer. Okay. Consider the following statements regarding PE. A company with negative EPS may render PE ratio economically meaningless for valuation purpose, because I know PE is equals to MPS upon EPS. If my EPS is negative, then what is the purpose of finding it? Do you think now the answer that you will get will be meaningless? Of course, correct. If my denominator is negative, my answer is negative. So yes, it is now meaningless to me. Option statement number 2, a higher retention ratio. Let's come back to our original EBIT statement. This is correct. My EBIT statement, EBT minus T EAE divided by number of shares. It will give you what? It will give you EPS, right? Which will be divided into 2 portions, that is DPS and retention ratio, right? They are saying if they have higher retention ratio will always increase Always increase the justified PE, irrespective of the relationship between ROE and cost of equity. Wrong. This is incorrect. How can this be correct? If I have higher RE, I have less DPS. If my DPS is low and the relationship between ROE and COE is not taken into account, the PE ratio will not give you the correct picture. It will not give you the correct picture. So this is wrong. You have to, if your ROE is more than your cost of equity, that my equity is giving me 10% of returns and the cost required for getting this return is 8%, then it is justified. It makes sense, right? Retain some money and my EPS will increase. But if my return on equity is only 10% and the cost, related cost KE is 12%, should I invest in this company? It makes no sense. Higher retention ratio can only be justified if my ROE is more, the returns that I am getting on equity is more, and the cost related to equity is less. Only then it makes sense, right? So this is wrong. Non-recurring income items distort the usefulness of PE ratio in comparative valuation analysis. Correct? Items which will not occur again and again, it will distort my PE. Correct? Changes in accounting policies may affect EPS and thereby reduce comparability of PE. Correct? If my accounting policies have changed, because of this, my IPTA will change. Because of that, my EBIT will change. Because of that, my EPS will change. And my PE ratio will be changed. So this is correct. Empirical evidence has often shown that low PE stocks may outperform the broader market over long period. Correct. Absolutely right. Lower the PE, meaning less amount I have to spend in order to receive more. So yes, they will give you broader market outperform the long term, it will outperform. This is correct. So only 2 is not correct. So the correct answer is C. The correct answer is C. I hope you were able to do the question. I hope you are able to do these questions. These are very good questions because all logical. These are all logical questions. Were you all able to do it? Okay, next. Let's do the next question then. See the correct answer. An equity analyst was evaluating the shares of a mid-sized firm. The company is expecting retain 65%. So how much will they pay out? For 35%. While distributing the remaining profits as dividend. So dividend payout ratio is 35%. The expected return on equity is 22 and the shareholders' required rate of return is 16. Okay. The analyst intends to estimate the justified forward PE multiple. Using the fundamental determinants approach, use the justified PE model. Okay? So let's find out the justified PE model. We can very easily calculate it. So how will we do it? The formula is simple. 1 minus B. That how much B is your retention ratio. See, I told you, remember just one formula. Did I not say you this? I told you, remember just one formula, right? D1 is the dividend payout. Can I write dividend as 1 minus retention, where retention is B? B is the retention ratio. So dividend will be 1 minus retention. Correct? If my retention is 65, so my dividend is 35. So 1 minus 65 is 0.65 is 0.35. So is this 0.35 not a dividend? It is dividend only. Divided by KE minus G. Divided by KE minus G. Can I write KE, and the formula for G is what? ROE into retention ratio, which is B. Retention ratio is denoted by B, right? So can I write it as KE minus ROE into B? Makes sense, right? I've just simplified the formula. Nothing. I told you learn one formula only, and it is more than enough for your exams. So I know dividend is, if EPS can be divided into two portions, which is dividend and retention. Dividend and retention, two things only I told you to remember. So if my retention is 60, my dividend will be 40. If my retention is 65, my dividend will be 35. So I have just substituted the values. Instead of D1, I am writing 1 minus B. 1 minus retention ratio divided by KE, which is your R, minus G. And the formula for growth rate is ROE into retention ratio. ROE into retention ratio. Simple. I have just put this formula, and this formula will give you, this will give you your adjusted PE. This will give you your adjusted PE. Let's put the things into motion now. So it will be 0.35 divided by KE's, because the retired rate of return is 16, so my cost of equity will be 16, minus ROE is 22, so 0.22 into B is 0.65, and you will get your answer, which is 0.22 into 65 will be 0.143, so 0.16 minus 0.143, 0.017, so it will be 20.59. So it will be 20.59. C is the correct answer. C is the correct answer. I hope you are able to do the question. Right? I told you, remember, only one equation, one formula only, D1 divided by KE minus G, where B is the retention ratio. So 1 minus retention is your dividend payout ratio, divided by KE minus G. G is what? Rate of return on equity into retention ratio. Simple. Don't have to learn 10 formulas. You don't have to learn 10 formulas. Okay. So your answer will be this. I hope the numerical portion you are able to do. I've also given you the answer here. Next. Listed manufacturing company witnessed a sharp increase in its share price after analyst highlights its strong revenue growth and improving return on equity. However, some investors remained cautious because the company had recently undertaken heavy capital expenditure. Okay, and carried substantial intangible assets related to brand acquisition and software development. The company's CFO argued that the valuation based only on earnings could be misleading due to fluctuating depreciation charges and one-time restructuring expenses. Meanwhile, another analyst compared the company's valuation multiples with industry average and observed that the company's PS ratio was lower than peers despite faster sales. Which of the following statements regarding PE, that is price to book value, and PS, price to sales, are correct? A company may have a meaningful PB even when its earnings per share are negative because book value is generally positive. Do you think this is correct? Let's write down the formula then. Let's write down the formula. Formula is price divided by book value, right? So, no, in the whole formula, there is no EPS. And even if the EPS is negative, the book value will be positive, right? So, negative EPS will have no impact on this formula. So, this is correct. This is correct. Next, inflation and technological advantage can reduce the gap between book value and market value. No, the gap between book value and market value will definitely increase because of inflation. So this is wrong. A low PS multiple relative to industry peers may indicate undervaluation, but industry characteristics and profit margins must also be considered. Yes. If my profit to sales ratio is low as compared to my peers, then this indicates that I am undervalued for sure. But I should take into consideration my profit margins as well. Somebody has raised their hand. Yes, Karan sir. Go ahead if you have a doubt. If you have a doubt, please ask. Karan sir, if you have a doubt, please ask. Okay. Next question. Or next statement. Statement number 4. Which says Sales figures are generally regarded as less susceptible to accounting manipulations than earnings figures. Correct. Sales are true. What has actually happened? Your accounting policies, whatever, it will impact your EPS, but it will not impact your sales. This is also correct. The PS multiple becomes completely ineffective when the company has negative EPS. Correct. No. No. Incorrect. Because in PS formula also EPS is not there. Right? For PS formula it is price divided by sales. EPS has no impact on my sales. So even if my EPS is negative, it will not impact my PS ratio. So 5 is wrong and 1 is wrong. So wherever you're seeing 1 and 5, get rid of it. So only B is the correct answer. 2, 3, 2, 4. Oh, none of the following is correct. Oh, 1, 3 and 4 are correct. So A is the correct answer. Is the correct answer. Sorry, 2 and 5 are incorrect. So wherever you can see 2 and 5, get rid of it. Okay, no problem, Karan sir. Next. I hope it is making sense to all. Are you all able to do the questions? That is most important. Just turn please this way. I hope it is making sense to all. Okay, next question. A is the correct answer. A listed company is being evaluated by equity analyst using both price to book value and price to sales. The following information is given to me. Which of the following combines correctly represents PB and PS? Okay. So PB will be how much? Calculate kar lete hain. PB will be how much? Price to book value, right? Price to book value. Do you have the price with you? Do you have the price with you? No, I do not have the price with me. But I have one formula, that is D1 upon KE minus G. Right? I told you, remember only one formula. Can I write D1 as DO into 1 plus G? I can. Which can be DO into price, I have to find out, right? Which can be DO is equals to 1 plus G is what? ROE into 1 minus B. Right? Divided by KE minus G. If I solve all of this, will it not be ROE into 1 minus B? Right? ROE into 1 minus B. Can I write it like this? If I'll open the formula, plus and minus 1 will be left, and only ROE into 1 minus B will be left. That is the growth. Oh, sorry. ROE is not 1 minus B, it is B. ROE into B. Right? Can I write it like this? Can I write D instead of D1? Can I write it as ROE into 1 minus B? It will give me my instead of D1 I can write this divided by KE minus G, right? Using this formula, you can very easily find out P, right? So it will be ROE into 1 minus B divided by R minus G, and it will be PV divided by PB. So even if this formula is not making sense to you, just remember for PB, the formula is ROE into 1 minus B, which is return on equity into your dividend payout ratio divided by KE minus G, which will be 24.24 into 1 minus B. B is 40% retention ratio, so your dividend payout is 0.6 divided by KE, your return is 18 and your growth rate is 12%, and you will get the answer, which is 2.4, so this is not correct, one of the following is correct, right? Let's find out PS as well. For PS you should use the formula NPM into 1 plus G into 1 minus B divided by R minus G. If you are unable, see, all the formulas in the world are depicted from P0 is equals to D1 divided by KE minus G. If you are unable to remember the logics, I'll not spend more time over it. This is your exam week and you have 2 exams this week. So let's not spend more time over how you can retain it. I can very easily give you the direct formula, that is net profit margin into the growth rate, that is 1 plus G, into your dividend payout ratio, that is 1 minus B divided by R minus G. Put it into the formula and you will get it. Profit to sales will be net profit margin. What is the growth rate? What is the dividend payout ratio divided by R minus G, which is K minus G. Put it into it and you will put the ratios over here and you will get 0.90. 0.90 approx. So B is the correct answer. B is the correct answer. I hope you are able to do the questions. I hope you are able to do the questions out here. Chalo ji, let's move ahead. Let's move ahead. Next question. A mid-sized listed manufacturing company, after 3 years of rapid expansion, attracted significant investors because its EPS have grew by 28%. New EPS is X plus 28%, while the overall market remained at 11. Okay. Despite this, the analyst observed that the company's stock traded at PE ratio only slightly above the market average. Another competing firm in the same sector reported a higher ROE but much lower net profit margin due to aggressive pricing. A brokerage report further noted that during the period of high market growth, slower growing firms in the industry often appeared cheap when assumed through PE analysis. The investment committee of mutual fund debated whether modified valuation provided better insight than standalone PE or PB ratio. Which of the following statements are correct? PEG ratio adjusts the traditional PE by incorporating expected growth as its companion variable. Do you think this is correct? 100% correct, because PEG incorporates the growth rate, the expected growth in EPS into valuation. So this is correct. This is correct. Right? Then in modified valuation multiples, ROE acts as a companion variable for PB, while NPM, net profit margin, acts as the companion variable for NPS. This is also correct. For PS, I know NPS will be taken into account, and for PB, ROE will be taken into account. So this is also correct. A PEG ratio greater than 1 always conclusively proves that a stock is fundamentally overvalued. Do you think this is correct? No. No. It not necessarily proves this. No. A relative PE ratio is calculated by dividing current PE by current PE ratio of the market. Do you think this is correct? Correct. Relative PE is my ratio divided by market ratio. So this is also correct. In high growth market environment, firm grows substantially slower than the market appears. Correct. This is also correct. So only 3 was not correct. So the correct answer is B. Oh. Only 3 was incorrect. So your current answer should be A. A is the correct answer. Next. A portfolio manager is comparing the valuation matrix of 3 listed companies. Company X, Y, and market average is given to you. Further, analyst estimates that company has ROE of 24 with PB of 3.6, while Y has NPM of 12 and PS of 1.8. Okay. Company X has a PEG ratio. Which of the following statements are correct? Company X has PEG ratio of 1.11. Calculate it. Let's calculate the PEG ratio. What is the PEG ratio? What is the formula for PEG ratio? It will be MPS divided by EPS. I'll find the PE ratio. First, let's calculate that. And then we can calculate PEG ratio. Because PEG is what? PE divided by EPS, expected growth rate basically, not EPS but growth rate. So let's find out my PE first. Let's find out PE. Here I can find out PE. PE will be MPS divided by EPS. That is why I told you, remember this formula. It will be required in all the questions. It will be, oh, they have already given you the EPS, 36 and 45. Right? So your PE ratio will be 720 divided by 36, and so company X will be 720 divided by 36, which will be 20. For X it will be 20, and for Y it will be 540 divided by 45, which will be around 12. This is my PE ratio. I know PEG का formula क्या है? PEG is nothing but your PE divided by your R, expected growth rate. G, sorry. Right. So PE is 20 for X. PE is 20 divided by growth rate. Expected annual EPS growth rate is 18%. So 0.18, which will give you 20 divided by 0.18 or 18 also you can take, because both the things PE ratio is also in absolute terms. So it will be 20 divided by 18, which will be 1.11. This is correct. First statement is correct. Second statement is telling you that company Y has a relative PE ratio of 0.60. Relative. How do I find out my relative PE ratio? First of all, tell me that. Relative PE ratio is current PE ratio divided by current P ratio of market. My ratio divided by market ratio. So my PE ratio is for 12. We have just calculated it. So 12 divided by market 20. So 12 divided by 20, which is approx how much? 0.60. This is also correct. Third statement, it is showing the value ratio of company X is 0.15. What is the formula for value ratio? Value ratio is PB divided by ROE, which is PB divided by ROE. PB is how much? PB, have they given it to you? Yes, 3.6 divided by 0.24 or 24 also we can take, absolute में दोनों absolute में ले लो. 3.6 divided by 24, which is 0.15. So this is also correct. The PSM multiple of company Y. How do I calculate PSM? PS divided by NPM, which is PS divided by NPM. You will have your PSM multiple. PS, I have given you PS ratio 1.8, NPM 12. So 1.8 divided by 12, which will be 15. So this is also correct. 0.12 ले लो. Now next they have asked you, based on PV ratio alone, company X appears relatively more expensive than fairly valued. Do you think this is correct? See, the PEG ratio is greater than 1. It is given to us. It generally will tell you that the stock is expensive. It is overvalued. It generally tells you that. Since on PEG only, it is 1.1, which is more than 1. It tells me it is expensive. Only PEG if I have to take into consideration and nothing else, then I'll say that this is also correct. So D is the correct answer. D is the correct answer. D is the correct answer. Is it making sense to you? Are you able to do the question? This question had a lot of formulas. I have given you formulas by the end of this PPT. I have given you formulas in the comment section, in the answer as well. Okay, so don't worry about that. It will be easier for you to remember the formula, so you don't have to worry much about that. I have given it to you at a place, so don't worry about that. Is there any doubt? Please ask. This is a good question. Do you have any doubt? Ask me. Anybody, any doubt? Okay. Next question then. A diversified manufacturing company is evaluating acquisition of a mature company. The target company has stable EBITDA, moderate debt, and has recently completed a large capex, resulting in lower near-term FCFF. During valuation, analysts from different advisor firms debated the appropriateness of various EV multiples. The analyst argued that EBITDA-based valuation is more stable, while other highlighted that FCFF can fluctuate significantly due to capex and working capital changes. A third analyst pointed that EV multiples are affected by growth, ROIC, tax rates, and reinvestment, and WACC. Based on the evaluation principles related to EV multiples, which of the following is correct? EV by EBITDA multiple may become overstated if excess cash is not deducted, because interest income from cash is excluded from EBITDA. Do you think that is from EBITDA? Have you excluded your interest income? Correct. Absolutely right. EV by EBITDA will be overstated if you will not subtract your excess cash, because EBITDA, it doesn't have your interest income, that is in cash balances, right? If there is an interest on cash balance, I have not taken that into account in my EBITDA. So yes, excess cash should be deducted. Excess cash should be deducted. So statement number 1 is absolutely right. Statement number 1 is absolutely right. Statement number 2, EBITDA and FCFF always move proportionately because both represent identical measures. Do you think this is correct? No, this is incorrect. The statement is wrong. Why? Because EBITDA and FCFF are not identical. EBITDA is only earnings before interest, taxes, depreciation, and amortization, while FCFF is actually free cash flow for the whole firm, after paying everybody else, after taking into account depreciation, after taking into account capex, after taking into account change in working capital. So they're not similar, they're not identical. So why will they move proportionately? This is wrong. This is wrong. Statement number 2 is incorrect. A higher weighted average holding all other variables constant generally reduces EV based multiples. Correct. If my WACC is high and everything else is constant, it will reduce. It will reduce my EV multiples, because most of the EV multiples have WACC minus G, right? So this is correct. Your statement number 4 says EV by free cash flow for the firm multiple fundamentally depends on WACC and growth rate. Absolutely right. If EV by book value multiple analysis, if ROIC equals the growth rate, okay, the enterprise value theoretically becomes 0 irrespective of WACC. Can never be. You have to always take into account WACC. So this is also wrong. So 1, 3 and 4 are correct. So A is the correct answer. A is correct. A is correct. Anybody has any doubt, please ask. If anybody has any doubt, this is the time where you ask questions. Any doubt? Okay, let's move to this next question then. These are good questions. A valuation analyst is tasked with valuing a mid-cap company in a cyclical industry, the analyst is considering the use of different valuation multiples as PE, EV, and PEG. However, there is an internal debate on whether to rely on single multiple or use multiple approaches. Senior management is also concerned about comparatively issues and the reliability of earnings. To strengthen conceptual clarity, the analyst also revisits general principles. Which of the following are correct? EV is calculated as market capitalization. Market capitalization is what? MPS into number of shares, which is equity, plus total debt minus cash and cash equivalent. Do you think this is correct? Yes, the statement is correct. 1000% the statement is correct, because EV is for all less your cash reserves and marketable securities. IPTA excludes depreciation and amortization expenses from operating profitability. Correct. PEG ratio adjusts the PE ratio by incorporating companies' expected growth rate. Absolutely right. Which is PE ratio divided by EP expected growth rate, that is G. A higher R squared value in regression indicates a stronger explanatory power. Absolutely right. In cyclical industries, analysts often prefer using normalized earnings. Correct, because I will take into account seasons. I will reduce my SIs, that is seasonal indices. I will and only trend and secular will be taken into place. All sort of normalized earnings I have taken, just all sort of seasonal variations or cyclical variations I have excluded. That is why normalized earnings are taken into account. So all 4 are correct. So D is the correct answer. All 5 are correct. So D is the correct answer here. Any doubt, anybody? Please ask. Very important. Very important module and very important questions that we are doing today. Right? Next. BML Limited is evaluating its valuation using book value approach. The management is reviewing whether balance sheet figures truly reflect the company's economic worth. They are also discussing alternative adjustments, such as replacement, liquidation, and the treat of intangible and non-operating assets. Which of the following statements are correct? Book value approach generally assumes that the balance sheet values are a reliable proxy for economic or market value under stable conditions. If the conditions are stable, then book value is actually representing market value. Do you think this is correct? No. Book value is never a reliable proxy, especially when inflation is there. There is advancement in some sort of technology, or you have a lot of intangible assets which their valuation keeps on changing. So this is not correct. This is not correct. Even if there are stable conditions, this is not correct. Replacement cost approach can provide a more realistic measure of asset. Replacement cost is what? Market value approach, right? For estimating future earnings. Yes, correct. Intangible assets such as brand value are usually excluded from traditional balance sheet valuation. Correct. Correct. In traditional balance sheet, you don't take into account brand valuation, right? Liquidation value approach values a firm as a going concern. Are nahi. Liquidation, we assume that there is a finite life and we should take assets separately and get the highest value. So this is wrong. Market inefficiencies and lack of active markets can lead to difference between book value and actual economic value. Correct. So 2, 3 and 5 are correct. 2, 3 and 5. C is the correct answer. C is the correct answer. C is the correct answer. Any doubt, anybody here? Please ask. With this, we are able to end our unit number 3 also. We'll move to unit 4 now. Any doubt, anybody? Please ask. Good question. Okay, let's start unit 16 then. It has been almost 4 hours of us doing the questions. Let's do the special valuation cases and then we'll move to our unit 17. Right? Good. Very small unit. Basically for theory, there is more theory in this unit. Only 2 units are left. 3 units are left after this. And we are good to go. Right? So let's do. So, but this unit number 16 is very important for theory. So don't assume that if you will leave this unit, then you will get no questions from here or anything. No. Every year we see that there are very good theory questions that come out of this particular topic. Let's do the questions. Let's at least do the concepts first, and then we can take a break, and then we can do questions after that. This is special cases of valuation, unit 4 for this module and unit 16 in total, which is very important for theory. What is startup valuation? How do you value startups? There are certain sort of challenges when there is a startup valuation, since it has no profits. There is very limited history for any new startup, and there is very high uncertainty of even its survival. So there are a lot of challenges for startup valuation, but we came out with certain methods. We did a lot of research and we came out with certain methods. One of the methods is venture capital method, scorecard method, and Burkus method. All very important for MCQs, for theory, direct theory you will get from here. Distressed company valuation also we did in this particular unit. Distressed companies are which companies? Companies which are unable to survive. It has become very difficult for them to survive in the market. They are distressed right now. They are on the verge of liquidation. So how do I do valuation for them? These companies are facing insolvency, bankruptcy, NPA situation is there. So what do? We have two methods, liquidation method and recovery method. Then you have brand valuation. Another valuation which is also very difficult to calculate. For this, we have brand recognition, customer loyalty, and market position. Because of this, there is brand valuation, right? Then there are intangible assets like goodwill, patent, trademark, copyright. These are also special cases. What are intangible assets? Intangible assets are assets which can be seen but cannot be touched. For example, and sometimes they cannot even be seen. Goodwill, cannot see it, cannot touch it. Patents, yes, there is a document for it, but cannot touch it. Cannot touch the patent itself, right? It's a concept and not a substance, right? So patent. Okay, let's do question. A pharmaceutical company, Zenith, spent heavily over 2 decades building its vaccine research, intangible, global distribution network, intangible, and brand reputation, intangible asset. During a strategic review, analysts observed that the company's balance sheet reflected only a fraction of its market value, despite strong investor confidence. The board debated whether traditional accounting methods were adequately capturing the company's intangible strength. Simultaneously, a rival firm attempted to estimate the value of the firm assets before considering an acquisition proposal. So, which of the following statements regarding the valuation of intangible assets? Even if they did not write this, we should understand from the question itself that this is about intangible assets. If they are correct, the value of a trademark may be estimated using DCF based on expected exclusive cash flow over its life. So if a trademark can give me exclusively some free cash flows or cash flows in the future, so can I use DCF for calculating the value of this particular trademark, copyright, license? Same things. If it was not written trademark, if it was written license, if it was written trademark, copyright, all of these will generate me certain cash flow in the coming future, in the coming years. What if I discount those cash flows? I estimate these cash flows and then I discount them today. I'll be able to find the value of this particular license, this particular copyright, this particular trademark. Can I do that? Yes, correct. So statement number 1, 100% correct. Statement number 2. Independent intangible assets generally require perpetual cash flow assumption because they normally do not have finite legal lives. Wrong. Or mostly intangible assets have finite life. For example, patents usually have 10 years of life. Relative valuation of intangible assets may The question was do not, but they do have, right? So the answer is wrong. Relative valuation of intangible assets may involve comparing firms possessing the assets with otherwise similar firms lacking it. Correct. Capitalizing historical advertising expenditure is one possible method for estimating the book value. Correct. Failure to properly account may distort ratios. Correct. This is also correct. So only 2 was not correct. Wherever you are seeing 2, get rid of it. C is the correct answer. C is the correct answer. Any doubt? Anybody out here? Any doubt? Anybody? Anybody? Any doubt here? Please ask. Okay. Moving ahead. A real estate investment company is evaluating whether to acquire a portfolio of mixed commercial properties across multiple cities. During a strategy meeting, analysts debate whether valuation approach traditionally used for equity shares can be applied for real estate. Okay. Some executives argue that real estate differs fundamentally from financial assets because of liquidity constraints, finite useful lives of building, and dependence on local expertise, and the difficulty in measuring market risk. Otherwise, maintain that valuation principles remain broadly similar because both the assets classes derive value from expected cash flow, growth expectation, and risk characteristics. The company is also examining whether CAPM, that is CAPM based discount rates, can reasonably be applied in estimating the value of long duration property investment. Which of the following statements are correct regarding valuation and risk assessment of real estate firms? Very important. In discounted cash flow valuation of real estate, the terminal value of the building may decline over time because physical structure can depreciate without usage. Do you think this is right? Yes. Even without usage, the depreciation will take place. But do you think the terminal value will decrease? Yes, correct. The building will lose its value because of aging. There is wear and tear. There is a limited useful life legally. So yes, definitely. The statement is correct. The terminal value will decrease. Okay. Real estate investments can never be analyzed using intrinsic value, which are only for listed securities. Who told you that? Who says such stuff? Wrong. This is wrong. We can use intrinsic value approach such as discounted cash flow. You use discounted cash flow for valuing shares. You can use it for using building. We have just estimated that DCF can be used. Statement number 3. The increasing securitization of real estate investor weakens the argument that real estate investors are necessarily poorly diversified. Read it again. Very good equation, very good statement out here. It is saying that increasing securitization of real estate investment. You have done securitization that you have divided into small units. It will weaken the argument that real estate investors are poorly diversified. How can you say that? If I have a small fraction of the building, this building has 100 floors, let's say. 100 apartments, let's say, but I have securitized it. I've divided into small fractions. If I buy 1 unit of it, I'm not saying 1 apartment, I'm saying 1 unit of real estate. It had 100 fractions, and out of that I'm buying 1. So I can do diversification now. Who is saying that real estate people are poorly diversified? No, securitization will help in better diversification of your funds, right? So third is correct. Statement number 3 is correct. 1000%. Okay, my screen is stuck, everybody. So give me 1 minute, please. Statement number 3 is correct. In CAPM, only diversified risk is compensated through higher expected return. No, we are taking risk-free securities as well. This is wrong. CAPM is what? RF plus beta into RM minus RF. We are taking into account beta. We are taking into account risk-free. So no, this is wrong. Land and building necessarily have identical economic lives. No, land has infinite life. Building has limited life. Wrong. multi-factor models may estimate the risk of real assets using beta factors, beta similar to those used for financial assets. Correct. Correct. Statement number 6 is correct. Last statement. If undiversified investor, person who's just putting his money into one place, okay, consistently demand excessively high returns from direct property investments, institutional structures such as REITs may become more attractive ownership vehicles. Correct. Correct. If a person who's putting money only in real estate, then REITs will become very attractive. Correct. So the correct answer is 2 is not correct, 4 is not correct, 5 is not correct. So A is the correct answer. A is the correct answer. I hope you all are able to do it. I hope you all were able to do the question. If you have any sort of doubt, please ask. This is a very good question because the language used in this question is unique. It is good. If you have a doubt, please ask. Anybody has any doubt, please ask. Okay, let's move to the next question then. A venture capitalist fund is evaluating 150 crore investment proposal from 2 early stage technological firms, that is startups. Firm A operates in the electric mobility analytics space and has reported rapid revenue growth during the last 18 months. Okay. Though it continues to incur operating losses because of aggressive spending, the company has limited operating history and no listed peers. Any sort of startup has no history as such. Firm B develops AI-enabled industry automation tools and has recently raised debt. Finance despite negative operating income. They had negative operating income, then too they took debt. Okay, very bold, I must say. Its management claims that future economies of scale and prosperity algorithm will eventually improve profitability. Okay. Analysts examining both firms disagree on a valuation approach because reliable historical information is scarce and future survival possibilities are uncertain. Makes sense. Which, with reference to valuation principles applicable to startup, which of the following? Even if they did not mention startup here, you should be able to identify this as a startup because just in the concepts I told you how startups are to be identified, right? In valuation of startup firms with negative operating income, revenue growth may be estimated first and reinvestment requirement may subsequently be linked through the scale sales to capital ratio. Do you think this is correct? Do you think this is correct? That in startups, you first talk about the equation where reinvestment is taken into account in the later stages. Do you think that is correct? Yes, correct. If operating income is negative, then I have to go with the traditional approach, right? That sorry, I cannot go ahead with the traditional approach. The traditional reinvestment will become ineffective. I should now focus more on survival and then, as per the sales to capital ratio, then talk about reinvestment. So, yes, statement number 1 correct. A firm's discounted cash flow can incorporate survival uncertainty either by adjusting expected cash flow directly or by separately assigning a probability of survival. Correct. You have to take survival risk here. A startup company, the absence of long operating history automatically makes discounted cash flow conceptually invalidated. No, it is not impossible. It is not invalidated. The framework become applicable. Only the assumptions that I will take now will be modified. So this is wrong. This is wrong. 4 is while estimating terminal value of a youth high growth firm, that is a young startup, assumptions regarding sustainable margins significantly influence the valuation outcome. Yes, these assumptions will change my outcomes, my valuation outcomes. Okay. In startup valuation, Outstanding employee stock options are generally ignored. No, ESOPs are taken into account. Wrong. ESOPs have to be taken into account. This is wrong. When conventional beta estimation is impractical, bottom-up beta estimation is to be taken into account. Yes, correct. A startup company with rapidly increasing revenues but persistently negative operating margins can still possess substantial firm value if future profitability are expected to improve. Correct. So 5 is incorrect, 3 is incorrect. Wherever you are finding 3 or 5, get rid of it. So C is the correct answer. C is the correct answer. Any doubt? Anybody here? Please ask. Any doubt? Anybody here? Please ask. Okay, next question. Next question, everybody. A manufacturing company has reported strong profitability over a decade. However, during the last 3 financial years, its earnings turned negative. It did not decline, it became negative. Okay. The board attributed the first year's losses to a nationwide transport strike and 1 year environment penalty. Okay. It's a event which is non-reoccurring in nature. Okay. In the second year, a severe downturn in global commodity prices sharply reduced revenue. Okay, makes sense. By the third year, analysts noticed that the company's aging plants, high labor cost, delayed technology upgrade, and rigid union agreement had weakened its long-term competitiveness. Okay. While some directors argued that the losses were temporary and cyclical, others believed that the firm required major restructuring and management changes before valuation estimates could improve. Okay. With reference to valuation of firm with negative or low earnings, examine the following statement. When losses arise from identifiable temporary events such as strikes or litigation, valuation may rely on adjusted earnings after removing the abnormal cost and related tax effects. Do you think this is correct? Yes. If there are abnormal losses which are temporary in nature, non-reoccurring, then you should take into account the abnormal portion should be removed and its associated tax benefit should also be removed. So statement number 1 correct. Statement number 1 is correct. Statement number 2. Okay, sorry. Statement number 2. For cyclical or commodity companies, current year earnings may provide misleading valuation signals during economic downturns or commodity price collapses. Correct. If it is a cyclical thing happening, if the whole cycle is toward depression or regression, then the valuation will be misleading. This is also correct. Right? Option number 3. In firms facing long-term operational inefficiency. Year 1 you were inefficient. Year 2 you were inefficient. Year 3 you were inefficient. Long-term it has become now. Valuation adjustment may require assumption regarding the timing and success of restructuring efforts. Correct. Now you have to take into account we have to restructure. Correct. A company's operational margin is generally considered an important indicator. Correct. This is also correct because operational margin is very important. Large companies often find operational restructuring easier. It is more difficult. It is more difficult for large companies. Wrong. Government regulations, labor agreements, and social pressures can restrict the pace at which the firm implement operational improvement. Yes, because the working condition is not appropriate. Replacing obsolete machinery is usually more time consuming and uncertain than retaining an existing workforce. Wrong. If you want to replace a machinery, go ahead, do it. So 7 is wrong. 5 and 7 are wrong. So wherever you're finding 5 or 7, get rid of it. So A is the correct answer. A is the correct answer. Any doubt? Anybody out here? Please ask. Should I slow down? Please tell me in the chat box. Should I slow down? Do you need a break? I understand there was an exam today. there is a text over the paid batch. Just give me 1 second. Understand there was an exam, you all are tired. Okay. Okay. Next. But we have to do the questions, everybody. Today is the only day where you can do the questions. Then tomorrow you again have your offices. I have my office. So yeah. What you can do is you will get the recorded batch. You can watch it there, or you can come over YouTube. And YouTube, we will have this lecture forever. Right? Okay. Next question. A rapidly expanding financial conglomerate operates across commercial banking, insurance underwriting, wealth management, and investment advisory. The company has historically maintained high dividend payout. However, recent regulations change have increased capital adequacy and tightened provisions norms for doubtful assets. Okay. The management is evaluating multiple valuation approaches. One analyst prefers a DDM approach, another argues for CFE, while a third recommends a asset-based valuation. Because the firm's loan portfolio carries interest rates significantly. Meanwhile, equity analysts disagree on whether historical earning growth remains reliable due to changing regulatory conditions and increased competition. Okay. With reference to valuation, which of the following statements are correct? Valuation of financial services. Now, even if this was not mentioned over here, even if it was not mentioned that this is a financial service company, by the question, you should be able to understand that this valuation is for financial service companies only. Because commercial banking, insurance, underwriting, wealth management is financial services, right? Now tell me. In financial services firm, debt is difficult to define precisely because deposits and borrowings are often integral to their operating activities. Do you think this is correct? Yes, this is correct. It is a difficult affair. Yes, it is correct. It is a difficult affair. So one is correct. Bottom-up beta estimation. Just 1 minute. Okay. Bottom-up beta estimation for bank regularly avoids unlevering and relevering because financial firms tends to operate with relatively similar or high leverage structures. Correct. When there is a relatively high leverage structure, you have to go with bottom-up beta only. So this is also correct. A high dividend payout ratio in banks necessarily indicate weak future growth potential. Weak future growth potential. Do you think this is correct? A high dividend payout ratio in banks necessarily indicates weak future growth. Do you think? Irrespective of capital requirement. Wrong. When stock buyouts are substantial, analyzing only dividend payout ratio may understand the total cash requirement of shareholders. Correct. Under the GG framework, Gordon Growth Framework, the stable growth rate assumed for a mature financial service company should ordinarily exceed the long-term growth rate of the economy. KE is more than G. Same, just different name. DDM only, just different name. Do you think this is correct? No. Stable growth rate. Stable growth rate should be more than long-term growth rate. No. Initial growth rate is high, long-term growth rate is high, but the stable is low. So this is wrong. In the asset-based valuation of a bank, the fair value of a loan portfolio may exceed its book value. May exceed its book value if contractual lending rates are above current market. Correct. During period of major regulatory restructuring, historical earnings growth rates of financial services companies may become less reliable. Correct. So 3 is incorrect, 5 is incorrect. 3 and 5, wherever you are seeing, get rid of them. C is the correct answer. C is the correct answer. Anybody, any doubt, please ask. If anybody has any doubt, please ask. Let's take a quick break. I can see you all are very tired. So let's take a quick break and then we will resume. Let's take a break for 10 minutes, then we'll be back. I hope you all are back now. Let's do more questions. Yes. Next question. A listed infrastructure company undertook aggressive expansion funded largely through debentures and forex loans. Due to slowdown in toll collection and delay in project execution, the company has reported continuous losses for the past 4 years. The market value of its asset has declined significantly, and analysts estimate that if the firm is liquidated immediately, the realizable value of asset may be lower than the face value of the outstanding debt. That is, liability is more, asset is low. Despite this situation, the company's shares continue to trade actively on the exchange with noticeable volatility. Some speculative investors have started accumulating the shares, arguing that future regulatory approvals and potential recovery in traffic volumes would sharply improve the firm's value before major debt maturities arise. Okay. With reference to the valuation of distressed firms, even if it was not written there, you should be able to understand that this is distressed firm. And the option like nature of equity, which of the following is correct? In a highly levered distressed firm, equity may continue to possess value even when the liquidation value of asset is currently below the outstanding debt obligation. Current value. Do you think this is correct? Do you think this is correct? Correct. 100% correct. Yes, even though this is distorted right now, but with the time, it will become better. With time, there will be improvement, and even though right now the assets are less than their liabilities, still we have an option which will help us significantly. So yes, this is correct. Limited liability ensures that the equity shareholders in publicly traded companies cannot lose more than their original investment amount. Correct. Because it is a limited liability. Right? That is why everybody has limited liability except for one. Except for one. So they loses only what they have invested. When equity behaves like a call option, that is, I have a right to buy, higher uncertainty in firm may increase the value of equity. Correct. Under the option approach, debt holders are economically similar to holders of a put option. Sellers. Correct. If in distressed firms, discounted cash flow valuation always produce a higher equity valuation. No. Wrong. Only 5 is not correct. So this is not correct. This is not correct. B is the correct answer. B is the correct answer. Next, a diversified manufacturing company reported a sharp increase in its cash and marketable securities during the year after selling a non-core division. Okay, the valuation team, they have sold a division which was not non-core. Okay, something which was not a core business for us. The valuation team used a discounted cash flow model to estimate enterprise value, making sense. One analyst included interest income from treasury investments while estimating free cash flow and added the entire cash balance separately at the end of valuation. Another analyst argued that the firm's strategic equity investments and undeveloped land parcels should be valued independently from operating assets. The board also observed that the company's operating cash requirement had reduced significantly due to increased adoption of digital payment. With reference to valuation of cash and cross holdings, which of the following is correct? Under a consolidated valuation approach, adding cash separately after discounting consolidated cash flow may result in double counting of cash holding. Do you think this is correct? That if you have first discounted it and then separately you are adding it, the cash will be counted twice. Yes. Correct. You have already counted it once. Why are you adding it again? Wrong. This will be double counting. Second, in separate valuation approach, interest income from cash and marketable securities should generally be excluded while estimating operating earnings. Correct. Cash should be excluded. Correct. Companies operating through a large number of small cash transactions generally require lower operating cash. No, if you have more cash transactions, you require more operating cash balances. So wrong. While estimating unlevered beta under a consolidated valuation approach, cash may reduce overall beta. Correct. Cash will reduce the beta because what is the beta for cash? Almost zero, right? Growth rates estimated under a separate valuation approach should reflect only operating earning growths. Correct. Correct. So only 3 is not correct. So A is the correct answer. A is the correct answer. Correct. A manufacturing company operates in highly cyclical sector. Okay. Linked to infra. During economic downturn, there is depression or regression. Its operating profit declined sharply. An analyst agreed on the valuation. One analyst used current depressed earnings directly in DCF, while another adjusted short-term growth assumptions. A third analyst preferred to normalize earnings. The company also had outstanding convertible bonds that could be converted into equity shares at a predetermined price. Management argued that these instruments should be treated differently from ordinary debt while estimating enterprise value. Yes, they're right. Which of the following statements are correct? Convertible bonds may not always be deducted from enterprise value like ordinary debt because their value is linked to common equity. Do you think this is correct? Do you think this is correct? Yes, since these are convertible debentures, convertible bonds, meaning that after a certain time period, you have an option to convert this bond into equity at a predetermined rate, at a rate that we have decided earlier, which will be, of course, lower than the current market price, right? So, do you think it should be deducted? It is more like equity or more like debt? It is more like equity. So, it should not be deducted. So, statement number 1 is correct. बिल्कुल सही है. Normalizing earnings using historical average is generally more suitable. We know in cyclical, you should always normalize earnings. You cannot take today's earnings. So yes, it has to be normalized. Correct. In cyclical companies' valuation, increasing near growth assumptions during an economy recovery may sometimes be justified. Yes. If you are near growth phase and you want to take recovery phase economies, it is correct. Using average historical earnings for normalization is most reliable. This is also correct. This is also correct. For normalization, let's take what has been happening in the past. If current earnings are temporarily depressed, replacing them immediately with normalized earnings without considering the recovery period can sometimes overstate. At least check what period we are in, right? So this is also correct. All 5 are correct. C is the correct answer. A diversified investment group primarily operated as a holding company with stakes in renewable energy, fintech and logistic firms. Over the past few years, the company earned strong dividend income from subsea. Recently, analysts found it difficult to estimate the intrinsic value because several subsidiaries were unlisted and future strategic division for the parent company could significantly influence returns. Very good. At the same time, Orion acquired a rapidly growing e-com ShopSphere, which specialized in AI-driven personalized retailing. Okay. Although ShopSphere has not yet generated consistent profits, investors valued it highly due to its technological innovation, changing consumer buying patterns, and expected market expansion. However, concerns remained regarding fast changing technology, intense competition, and the possibility of shifting customer preference. With reference to the valuation of a holding company and e-com, which of the following statements are correct? Holding companies are often valued by considering their ability to allocate capital efficiently and identify superior investment opportunities. Do you think this is correct? Do you think this is correct? Yes. Yes. Holding company are assessed not only on asset ownership but also on also on managerial capabilities. How can you allocate investment decisions, capital allocation? So yes, this is correct. DDM. DDM may be unsuitable for valuing holding companies. Why? DDM is suitable everywhere. So this is wrong. Rapid technology obsolescence can materially affect the valuation of e-com. Correct. E-com is based on technology only. Changes in consumer purchasing behavior are among the qualitative factors that influence e-com. Correct. The absence of current profitability automatically implies that e-com has no measurable enterprise value. No. Who said that? Even if there is not much profitability, it still has enterprise value, money which is for all the claim holders. So 2 and 5 are not correct. Wherever you're seeing 2 and 5, get rid of it. So A is the correct answer. A is the correct answer. Anybody, any sort of doubt? This is the time you ask the question, because we're done with this unit now. If you have any sort of doubts, please do ask your questions. Anybody has any questions, ask right away. Then I'll start with the next unit. Priya ma'am, any doubts, please ask. Okay, next unit. Let's start the next unit then. Next unit is merger, acquisition and restructuring. Again, a very important unit. Very, very important for your exams. I'll say if you miss this, you are actually losing free marks, because this is very simple and very important at the same time. See, there is one company, ABC. There is another company, PQR. Both the companies want to join hands. They want to join hands and form a new company known as XYZ. This is also merger. This is merger. Both the companies one could be small or one could be big, or they could be of identical size. They want to merge and form a new company. This is also merger. ABC and PQR. Now ABC is relatively bigger company and ABC wants to acquire PQR. This is known as acquisition. No new company is formed. ABC acquired shares of PQR and PQR is merged with ABC. This could also be a merger. Yes, this is also a part of merger, but known as acquisition. Known as acquisition. So both the things are different. They can ask you question on such that what is merger and what is acquisition. So there are important points that you should keep in mind, that when it is acquisition and when it is merger. Okay, when two companies combine into one. Example number 1, right? Because of what? Because they had synergy in their mind. Growth perspective was high. They could reduce their cost together. Their synergy, the energy that they will create together was very high. Their market share now that they will have is quite high. Acquisition is one company is purchasing the another company. Option. Example number 2. ABC is acquiring PQR More than 50% of PQR is under ABC now. So it is acquisition. One company purchases another. Synergy is value of A plus B will be more than value of A plus value of B, right? They together have more power. Even if you add both of their powers together, their power will be higher than both their powers. Combined company creates additional value. That is the meaning of synergy, and this they will ask you in exam. Types of merger. One is horizontal merger, same business. For example, one bank acquires another bank. Then you have vertical merger, that is supplier and customer, they join hands together. And then you have conglomerate merger, unrelated businesses come together. Can be asked in exams, right? Due diligence, investigation before acquisition. If I have to acquire you, I want to put my money into your business, I should do my due diligence. I should actually check what is your worth, right? I should check your papers, even if this merger is possible, if it is feasible, if it is legally allowed, financially in my favor or not, if there will be tax benefit or not, how my operations will work, right? So due diligence is to be done. These areas should be checked before putting my money by me, not by you, by me. I should do my due diligence before putting my money into you. Then you have reconstruction. Aside from merger and acquisition, another option is there with the company, that you can restructure yourself. Structuring, as in just on the paper, I want to change my structure, could be in the form of demerger. What I did was, I had a company, like for example, Tata had a company, big company. What they did was, they knew there was a different division, which was either not doing very good or was doing very good. So we want to make it a whole different area. So I will take out one division of me and create a new division, Titan. I created a new division, Titan. Now this is example only. Tata XYZ, Titan ABC, right? So I took out a portion of me and created a whole new business for a dedicated new division, dedicated new business. This is known as demerger. Then there is spin-off. There is slump sale. I have sold a major portion of me to somebody. And then there is buyback. Buyback is, I have bought my own shares from public. So these are reconstruction methods. Frequently asked questions are, horizontal merger happens between supplier customer. No, this is vertical. Unrelated person, conglomerate. Government entities, no. Competitors, same business. Okay, let's do the questions then. A diversified industrial group undertook multiple restructuring activities over last 2 years. Just 1 minute. Sorry, I had to take an urgent message. It merged with competitors, identical products in order to increase market share. Later, it purchased only the pharmaceutical division of another company. Acquisition. The group has also sold a major stake, slump sale, and a separate business was also created, demerger, right? In another transaction, an unlisted technology startup acquired a listed shell company to obtain stock exchange listing shares without launching an IPO. Oh, back reverse acquisition. Consider the following statements. A merger between two firms operating in same line of business is called horizontal merger. Do you think this is correct? I told you free marks. I told you free marks. This chapter is of free marks. Such easy questions, right? Do you think this is correct? Yes, this is correct. Statement number 1, correct. Okay, so my screen is hung. Yeah. Purchase of only a business division. I purchase a business division or plant necessarily results in transfer of company's entire assets and liabilities. I purchase their one division only. Why will there be an entire chain, entire transfer? No. Reverse merger or reverse acquisition, where a small company is acquiring a big company without launching IPO. This is a big company can eat, big fish will eat up the small fish. That is merger, right? Or acquisition, whichever name you want to give it. But have you ever seen a small fish eating a big fish? Not possible. But legally, it is possible when a small company acquires a big company without even launching IPO. This is known as reverse merger. So, a reverse merger enables an unlisted company, like in the example, to obtain listing status without undergoing the conventional IPO process. Yes, this is reverse merger. A small unlisted company has acquired major portion of a listed company. So yes, they can have one IPO here. Correct. Without going IPO, now you are listed. Now the small company, without even going through the IPO process, it is listed. In a demerger, the transferred undertaking moves to another company while the original company may continue to exist. Tata still exists, but the portion of it, Titan, is a new business now. So this is also correct. Sale of a controlling equity stake by one investor to another can be regarded as a form of distributor. Correct. Correct. So only 2 was not correct. So is the correct answer. A is the correct answer. Any doubt still here? Please ask. Please ask. It's a very, very good chapter and very scoring. And a lot of questions will be asked from here. If you have any sort of doubt, then this is the time where you ask me questions. Please ask. Please ask all of you if there are any sort of doubts. Very good unit and very scoring and very easy. Just follow the concepts that I'm giving you. Believe you me, this one PDF is more than enough. You'll get good marks. Chalo, next questions. Next question. A large industrial pharmaceutical company facing intense competition and rising R&D acquired a missized biotech acquisition, right? They have a niche in vaccine technology. Okay, the acquiring company, that is large Indian pharmaceutical, already possessed an extensive global distribution network but lacked innovative product pipeline. After the merger, the combined entity centralized finance, HR and legal operations while integrating research team to accelerate commercialization of product. Okay. However, some analysts questioned whether the merger would genuinely create shareholder value or merely increase the size without meaningful gains. With reference to merger and acquisition, consider the following statements. Economies of scales arise when an enterprise uses existing capabilities to expand into related activities or products. Do you think this is correct? This is 1000% correct. In the definition itself, it is said that if you are expanding into related services or related products, then you are economies of scale will be achieved. It will be achieved. So yes, this is correct. In a vertical merger, that is supplier to customer, improved coordination across stages of production may reduce inventory cost and strengthen the market control. Yes, supplier and customer are together now. The cost will come down, inventory cost will come down, market control will also go up. Correct. Diversification through merger always creates value for shareholders. Sorry, wrong. It is not true always. Wrong. A merger that increases earnings per share necessarily increases the market value of the combined company. Nobody has said that. Market value is market capitalization. MPS is main point, not EPS. MPS is the main point here. So wrong. Synergy in merger can arise from complementary strengths such as production efficiency and marketing capability. Correct. A and B together have more value of A and B combined. A plus B individually. So A plus B combined has more value of sum of A plus B. Right? So 5 is correct. 3 and 4 are not correct. Wherever you are seeing 3 and 4, get rid of it. So C is the correct answer. C is the correct answer. Any doubt, anybody here, please ask. I told you, very easy and very scoring. Next. Companies Act 2013 and Competition Commission of India are examining a proposed merger. Okay. Between two listed manufacturing companies, Alpha and Zenith, the board of both companies approved a draft amalgamation scheme. One company has foreign subsidiary involved, and creditors representing 92% of value have already submitted affidavits approving the approval. A minority group holding 8%, that is NCI, non-controlling interest, has raised objection. The company also intend to claim carry forward of accumulated losses after amalgamation. Of course, it makes sense. Which of the following statements are correct? Under Ind AS 103, Ind AS is Indian Accounting Standards for all the companies after 2016. After 2016 having net worth more than 500 CR, they have to go through these Ind ASs only. Acquisition method is generally applied to business combinations other than common control transaction. If there are common control transaction, other than that, all transactions will be taken over in this amalgamation. Do you think this is correct? It's pure accounting. It's pure accounting. Yes. Yes. You take care of everything when there will be amalgamation. If A, B, C and PQR are amalgamating, then all the assets, all the liabilities will be amalgamated. They will be combined, except if there was some common transaction, like there was already ABC and PQR, they already had some license, trademark, some transaction which was common for both. Like ABC was a debtor of PQR. So now this will be not taken into account. Everything else will be taken into account. So option number 1 is correct. Option number 2, statement number 2, creditors meeting may be dispensed with where at least 90% in value of creditors approve the scheme. Correct. If 90%, the mark is 90. If 90% approve the scheme is approved. Always remember, that is why my focus was on 92, because the mark is 90 of creditors. 90% creditors. Always remember. The Competition Commission of India may prohibit a combination if it is likely to cause a appreciable adverse effect on competition in India. Correct. Competition Commission might reject their proposal as well if they feel that this is unfair or unjust to competition in India. In the pooling of interest method, pooling of interest is when 90% of assets are taken over at book value. Assets and liability are recorded at fair value on the acquisition date. No. In pooling of assets, 90% of assets and liabilities are taken over at book value, not at fair value on the acquisition date. For certain tax benefits, shareholding at least 75% in value of shares of the amalgamation must become shareholders of the amalgamated company. Correct. So only 4 was incorrect. Rest everything is correct. So A is the correct answer. A is the correct answer. Any doubt here, please ask, because these are proper law questions. These questions are from Ind AS, Companies Act, Competition Commission. Any doubt, please ask. People over paid batch, any doubts, please ask. Okay, next question then. A technology conglomerate sought to acquire a smaller company to diversify its business. Zenith management projected substantial operational synergy through integrated supply chain, shared R&D, and lower finance cost. Okay, makes sense. The acquisition proposal included a mix of cash and equity settlement. Okay, in my purchase consideration, I have cash, and I will take over your business. I will give cash and shares to your shareholders. Purchase consideration has cash and equity, leading to intense debate among shareholders regarding valuation, taxation, and post-merger ownership rights. Okay, some directors argued that stock compensation would align long-term interest of both firms, while others believed cash financing would impose stricter financial discipline. During negotiation, analysts also questioned whether shares were trading above their intrinsic value. Which of the following statements regarding merger and acquisition compensation, that is the purchase consideration that you will pay, right, methods are correct? See, I want to acquire your business. I will find out your intrinsic value. I'll take your assets and I will pay you something, right? If I'm buying you, I have to pay you. This is known as consideration or compensation, right? So which of the following are correct? So for compensating what I have bought from you, I will give you cash and I will give you equity shares of my own company without you paying me anything. Okay. In a cash finance acquisition, the acquiring firm, me, ABC, that is Zenith in this question, the acquiring firm's cost of merger is calculated as cash paid minus the standalone value of target value. Target firm, do you think this is correct? Do you think this is correct? If I am paying you cash, I calculated your intrinsic value and you are worth 120 crores. And now I am paying you 120 crores in cash. Okay, give me your business, take 120 crores, go. So what I'll do is in this whole transaction, if I will pay you the cash compensation less what is the present value of the target company. You are my targeted company. What is your present value? So cash minus present value of your company is the cash acquisition point, is the merger cost from the acquisition perspective will be how much have I given you less what was your present value. So I calculated your present value, it came to 120 CR and I paid you 121 CR. So 1 crore is my merger cost, is a cost that I have borne to take your company. Because your company was already worth 120 CR, but I have given you 121 CR. So the 1 CR that I have paid you extra, that is acquisition amount less, the amount that I have paid you less what was your worth. That is a cost, legal cost that I have to bear. It is my merger cost. It is a cost that I want to take your company. So the given statement is correct. The given statement is 100% correct. Okay, next statement. Next statement is, just 1 second. Under stock compensation, I calculated your intrinsic value. Now I have to buy your company, so I'm giving you stocks. I'm giving you my stocks without charging you anything. Okay. So under stock compensation, the true acquisition cost depends partly on proportionate ownership obtained by target shareholders in the merged entity. So when I'm offering you my own shares, so what is my cost of merger? What is the cost that I have to bear for merging you with me? It is nothing, but it depends on what your shareholders, the target company, you are the target company, I am the acquirer company. So your ownership in my company, since I'm giving you my shares, you have become owners of my company, right? So your ownership will determine my merger cost. So this is also correct. This is also correct. Shareholders of the acquired company, you are the acquired company, generally face immediate tax implication. No. When you will sell your shares, then you will have tax implication. Not immediately. You have got shares of my company without paying anything, right? It is not a capital gain. When you will sell these shares, then you will have tax implications. If the acquiring company shares are overvalued, related to the target company, stock compensation may become a strategically attractive option. Correct. Right? If my shares are overvalued as compared to yours, then stock compensation is a better move. Rather than giving you cash, I should give you my shares only. Empirical observation often indicate that cash finance acquisition tend to exhibit greater managerial discipline because my equity is not diluted now. If I have given you cash, you are out of my life now, right? But if I have given you equity, I have given you stocks, now you have my equity, my ownership has been diluted. Now you will always be involved in my business. So fifth is also correct. So third was incorrect. So B is the correct answer. B is the correct answer. Any doubts? Anybody, please ask. If anybody has any sort of doubts, then you should ask right away. These are good questions. If you are doing this and you are able to retain them, I can guarantee you, you are scoring very, very good in your exam. Okay, next question. A manufacturing company is considering acquiring another company to strengthen its stock supply network. Okay, before the merger, the market value is 180. I want to buy you. Orion wants to buy Nova. So before the acquisition, Orion is valued at 180 and you are valued at 60. You are a smaller company, I am a bigger company. Analysts estimate that the merger would generate operational synergy with a present value of 30. So the new should be 180 plus 60 plus 30, right? Orion proposes to acquire Nova through cash of 72. So instead of 60, I am paying you 72. I am paying you 12 extra. Based on the above information, which of the following statements are correct? The total benefit arising from the merger is 30. No. The total benefit is not 30. Do you think this is correct? Do you think that the total benefit is only 30? I am 180, you are 60. And I will have a benefit of 30. You are 60, but I paid you 72. Right? The combined value will be 80 plus 60 plus 30, which is 270. Right? Benefit from the merger will be how much? 270 minus 180 minus 60, which is 30. So yes, makes sense. Makes sense to me that all of this that I did was for this 30 only. For this extra 30 only. The whole exercise that we have done together of me acquiring you, even though you were just 60, I acquired you at 72. Just to get those 30, the present value of synergy. So this synergy has already taken effect of 72 in it. Those extra 12 is already included in this 30. So yes, statement number 1 is correct. Statement number 1 is correct. Cost of merger is 12 CR. Do you think that is right? Do you think this is right? The cost is 12. What is your present value minus the cash paid minus the present value? Yes. In the previous question we did it. Statement number 1. The cost of merger is what I paid you less what was your value. That is my cost. 12 crores I had to bear. It is my cost of the merger. To get the synergy of 30, I paid extra 12. So yes, this is also correct. Statement number 3. Net present value of the merger is 18 CR. Now, this is a very good statement. Very, very good statement because it has such a beautiful logical explanation behind it. See. Net present value kya hai? What is my benefit minus what is my cost? My benefit is 30. What is my cost of merger? 12. The benefit that I'll get is 30. And how much cost do I have to bear? 12. And what is my net present value? 30 minus 12, which is 18 CR. So statement number 3 is also correct. Total benefit is total synergy. Statement number 4. The NPV of merger to Nova is 30. Do you think? Net present value to Nova, the company that I'm acquiring, for them, they are the net present value is 30 to them. No, wrong. They are getting 72 while their worth was only 60. So their net present value is 72 minus 60, which is 12. The net present value that they are getting is 12, not 30. 30 I am getting. They're getting only 12 crores. So statement number 4 is incorrect. The combined value will be 270. Yes, this is correct. 180 plus 60 plus 30. 270. Correct. So only 4 was not correct. So B is the correct answer. B is the correct answer. Anybody, any doubt, please ask. I told you, easy questions, scoring, and a lot of questions that you will get from here. The weightage is high for this unit, you know. That is why I said that good questions and free marks. Next. A listed company proposed a merger with Beta. The board of Alpha. See, both are listed, by the way, because limited. Right? So, it has proposed a merger. The board argued that the exchange ratio should primarily rely on market price. If they were, since they are actively traded on stock market. However, some institutional investor opposed this view, stating that temporarily speculative activity had artificially inflated Alpha's stock share price. My share price has been artificially inflated. Meanwhile, Beta promoters insisted that the valuation should consider projected post-merger cash flows, okay, and long-term synergy benefit. The negotiation committee eventually decided to examine multiple valuation approaches. Which of the following statements regarding the exchange ratio is correct? Exchange ratio is what? Understand. Exchange ratio is if I am the purchasing company, I'm the acquirer, and you are the acquiree, you are the target company, right? I am saying I have to give you 60 CR. I want to purchase you. So instead of paying you 60 CR, your net worth is 60 CR. I'm going to purchase you for 70 CR. This is my purchase consideration. I'm going to give you what? 70 CR. This is what I'm giving you. Okay. 70 CR is my cost. This is what I'll bear. 10 CR is my merger cost. See? So what I'll do is I will give shares to you. You don't have to pay me anything. I will give you the shares of my company. But in what proportion? You have 10,000 shareholders. How many shares of my company should I give to your 10,000 shareholders? How do I determine that? And I'll say for every 2 shares held, if a person held 2 shares in Beta Limited, okay, let's make the example easier. For every 1 share held, if you held 1 share in Beta Limited, I'm ready to give you 2 shares of my company. So the exchange ratio is 2:1, 2/1. So for every 1 share held, I will give you 2 shares. For every 1 share held, I am going to give you 2 shares of my company. Right? So the exchange ratio is 2:1. This is the exchange ratio. A book value. Now if the exchange ratio is clear to you, now let's do the questions. The question says that a book value based exchange ratio may fail to reflect changes in the purchasing power of money. If you go exactly by what is written in the books in the balance sheet, then today's purchasing power of money will be neglected. It will fail to reflect the purchasing power of money. Do you think this is correct? Yes, because book value is typical historical information. Correct. The reflection of inflation is not taken into account. So statement number 1 is correct. Statement number 2. An EPS based exchange ratio, that is EPS of the vendor company divided by the EPS of purchasing company. automatically incorporates merger synergy and future growth difference between companies. Do you think this is correct? Do you think this is correct? No. How will EPS take into account synergy? No, this is wrong. Market price based exchange ratio are generally considered more reliable. Correct. Because it is exactly what is happening in the market. Let's create a swap ratio according to that. Dividend discounted value per share is more meaningful only when future dividend streams can be estimated with accuracy. Yes. This we know about DDM. That only if it is reliable, then only it is good. The DCF value per share captures the full value of embedded future opportunities. No. Full value. Full value can never be taken into account. No. So 2 is incorrect, 5 is incorrect. So A is the correct answer. A is the correct answer. Any doubt, anybody? Please ask. If you have any doubt, this was a good question. If anybody has any sort of doubt, please ask. Any doubt, anybody? Please ask. Okay, next question. A pharmaceutical company is acquiring Nova. The valuation company considered the approaches for determining exchange ratio. The following information is given to you. Okay. Which of the following statements are correct regarding the exchange ratio? Okay. Understand? Exchange ratio is target company divided by acquiring company. That is, I am selling you, so I am the vendor. You are I am purchasing you, I am the purchaser company. You are selling yourself, you are the vendor company. Right? So the exchange ratio, always remember in your mind, it is V upon P. V upon P. So whatever you take, amounts of vendor will be in the numerator and the amounts of purchaser will be in the denominator. So vendor here is Nova and purchaser here is Zenith. Right? So it will always be okay. Oh, you cannot see the options. Just give me 1 second. Let me adjust this for you. Okay, this is a problem. Just 1 second, please, all of you. Yeah, I think it is visible to you now, right? Yeah. Okay. Now, always remember that it is always V upon P. Victory upon problems. Always remember that. Victory upon problems. So vendor company will be in the numerator and purchasing company will be in the denominator. Right? So the book value based exchange ratio will be this much. Let's calculate. So book value of vendor is Nova and purchasing is Zenith. So book value of Zenith is 60 and the book value of Nova is 48. So 48 divided by 60, how much will it be? It will be 0.8. 0.8 and not 1.25. It will be 0.8. Since denominator is higher, of course it will be in point. So this is wrong. This is wrong. Statement number 1 is incorrect. Next. EPS base ratio is 0.6. Okay. EPS. This is book value. Now let's calculate EPS. EPS is 15 and 9. So 9 upon 15. Do you think it is correct? 3 and 5 and 3. 30.6. So this is also correct. Statement number 2 is correct. Correct हो गया ये तो. ये 0.6 हो गया. Okay. Next. The market price based exchange ratio implies that one share of Zenith Labs will be exchanged for 4 shares of Nova Beach. It's calculated. Market price of Nova is 30 divided by 120, which is 1 by 4. So for every 1 share held, you will be giving 4 shares. For every 1 share held, you will be giving 4 shares. So do you think this statement is correct? Yes. Yes. Statement number 3 is also correct. For every 1 share held, you are fine and ready to give 4 shares. The DCF value based exchange ratio is 0.75. Let's calculate that as well. For DCF, 45 divided by 75. 45 divided by 75, which is 0.6. 0.6, this is wrong. So fourth is wrong, incorrect. Statement number 4 is incorrect. Statement number 5, under the market price method, the acquiring company, that is Zenith, offers one of its shares for every 3 shares of target company, that is Nova, under market price 1 by 4. So this is wrong. This is wrong. Oh, sorry. Yes, this is wrong. Because it was 1 for every 4, not 1 for every 3. 1 for every 4, not 1 for every 3. So 5 is also wrong. 1 wrong, 4 wrong, 5 wrong. Correct answer is B. 2 and 3. Only 2 and 3 are correct. Only 2 and 3 are correct. Are you able to do it? Are you able to do it? Tanmoy sir, are you able to do it? These are good questions, very easy questions. Just remember the basic concept. Victory over your problems. V upon P, always. Vendor upon purchasing. And very easy questions. Next. B is the correct answer. Next question. A diversified manufacturing decided to disinvest basically its specialty chemical division. So they are demerging, okay, due to strategic reconstructing. Multiple bidders expressed interest because the division had strong cash flow but suffered from operational inefficiencies. One bidder, Apex, believed that after acquisition it could improve plant utilization, reduce redundant administrative cost, and refinance debt at a lower rate, okay, and expand distribution using its existing network. Okay, a lot of faith he has in himself. During negotiations, valuation consultant used both DCF and market multiple approach. Okay. However, analysts differed sharply regarding growth assumptions, cost of capital, and the selection of comparable companies. Shareholders of both firms debated whether the acquisition price fairly reflected the division intrinsic value. Which of the following statements are correct? Under DCF, enterprise value is generally obtained by combining present value of free cash flow with discounted horizon value. This is a good question. Correct. This statement is correct because DCF typically involves what? It involves estimating the present values of forecasted period, right? And the terminal value, which is the horizon value. Terminal value is what? On the horizon, you will be stabilized. So terminal value is what? Horizon value. So this is correct. Next. A control premium may arise because an acquiring firm expects to improve operations after obtaining managerial control. Correct. They'll ask for a control premium, of course. That if you want to have a control, then pay a premium. The market multiple method assumes that comparable asset is similar conditions should broadly command comparable valuation. Yes, there should be a comparable valuation for similar identical units. Synergy value can include benefits such as lowered overhead cost, improved debt capacity, and marketing position. Correct. In acquisition valuation, biases may arise because assumptions regarding growth rate, KE, and comparable firms can be selectively adjusted to support a preferred valuation. Correct. Yes, these are based on judgment. So yes, they can be biased also. True. So all 5 are correct. D is the correct answer. D is the correct answer. Next question. Any doubt, anybody till here? Please ask. Please ask. Okay. So Tanmoy sir is saying that it is his first live class and he has not studied till now. Okay. Now I know most of you are in the similar situation where you studied for any two subjects. Now the mark is 45 and you have to anyhow do it in the last week. And the problem is that two exams back to back now. That is the problem. A big problem for you. I understand. I understand. This is not just you. A lot of students are facing the similar situation. So what you will do is, I'll give you one ram band. One ram band, and believe me, you when I tell you this, you will pass. I can write it and give it to you that you will pass. Just follow what I'm saying. All you have to do is, today we are doing this marathon and we'll cover the whole module C. Each and every question here that we are doing covers majorly everything that can be asked. Everything that can be asked, and it will cover. This marathon is covering it. Plus, for your benefit, what I'm doing is I'm giving you the conceptual clarity alongside, so that even if the language is changed, even if new questions are formed, even the questions that are on the basis of these questions are formed, you will crack those. Believe me when I'm saying this. Believe me, you will be able to crack these questions. Just the important concept out here is, do not miss these questions that we are doing today. Questions that we are doing right now, this marathon is very important. So if you are able to put in some good 7-8 hours to it, and you are able to do the questions, then nobody can beat you. This exam is yours, this promotion is yours. The only thing I'm asking is, do not skip. Do all the questions with the logical reasoning. And we are already doing conceptual clarity here. So nothing that will go over your head. Nothing which can not relatable. Do the questions here. We'll start the next unit. We'll help you more for the next unit. Just pay attention, and if you have any doubt, ask it right away. I will be always available over WhatsApp, of course. All the paid batch students can ask me any question. Even for YouTube, if you drop this is important information. Even if you drop a comment, I will definitely reply. 1000% I'm going to reply you. So do not worry. I'm here for you till the exam. And once we are done with module C for the paid batch, we will do the revision for module B as well. So don't worry. Okay, coming back to the question. People over YouTube, if you are liking, please press the like button, share it with your friends. Like तो बनता है, इतनी मेहनत कर रहे हैं. We are covering everything in module C with concepts, with numerical questions, with theoretical questions. Like तो बनता है, right? So like, please. Okay. Let's do the question now. The question is, Apex Limited, a listed electric vehicle component manufacturer, had been facing declining profitability. Okay. Repeated delays in product launch and shareholder dissatisfaction regarding managerial inefficiency. Sensing an opportunity, Zenith, every question has Zenith in it, holding gradually acquired 18% equity through open market. Okay, so now Zenith has how much? 18%. Now they have 18% over several months. Simultaneously, Zenith negotiated separately with the promoter family holding 22. They have taken 18 plus 22 more from a promoter. How much they have taken now? 40% of us they have taken. ठीक है. Minority stakeholders raise concern because the negotiated acquisition price paid to promoter was higher than the prevailing market price. Competitors and consumer groups also approached regulators, alleging that acquisition could substantially increase the market concentration in the sector. Meanwhile, Zenith argued that the takeover would create synergy. That okay, I can pay 100 rupees, even if the stock market price is right now 60. I'm ready to pay you 100. I know if I'll acquire you, it will create me synergy. So, which of the following statements regarding takeover and takeover regulations are correct? Whether I paid you 100 even though your market price was 60. What about the legality about it? So let's do the question. Effective control over company may sometimes be exercised with less than 50%, where the remaining shareholders are widely spread. C. I told you acquisition happens only if the controlling interest is more than 50%. More than 51%. Honestly, if it is 51% and above, only then you are holding company and I am your subsidy. Only then you have acquired me. Right? But what if I have 40%? Somebody else has 2%. Somebody else has 3%, 10%, 8%, and such small percentages people have. Only I am the one with such a large holding over the company. Do you think I am the holding company? And rest all are minorities, rest all are NCIs. Do you think that can also happen? Yes, correct. One other way of acquisition is when there is no clear 51% acquisition, then largest acquisition that person has the managerial control. When there is fragmented interest or fragmented holdings, then person holding the maximum will become the holding company. They will become the holding. So yes, I have effective control over you. Even though I do not have 51% of you, I still have effective control over you. So now whatever I say goes, because in the shareholders meeting, my votes will determine what to go and what not to go. I have 40% of the share and the rest 60% is spread. Some of them will not vote. Some of them might vote what I have voted. So yes, effective control is mine. Open market purchases are commonly associated with the initial stage of hostile takeover. If there is an open market, anybody can buy. Do you think this is hostile takeover? Yes. Dheere, in small ratios, in small numbers, I have picked your shares from the open market and in a hostile manner, I am trying to capture a major portion of you. So this is also correct. One objective of takeover regulation is to ensure that the minority shareholders are not unfairly disadvantaged when controlling shareholders receive a premium price. So yes, do you think this is correct? Yes. Now there are minority shareholders and there is a major shareholder. Just because you are getting 100 rupees and the correct price is 60, the minority will be disadvantaged now, right? Right? The minority might feel cheated and they will be unfairly disadvantaged. So yes, this is also correct because takeover regulation are there to help and protect the shareholders even if they are in minority. So yes, during the transfer of control, the minority are protected. So this is also correct. This is also correct. The HHI, that is the Herfidel-Hirschman Index, measures only the number of firms operating in an industry and not the distribution of market share among them. Wrong. Distribution is considered. So this is wrong. Supporters of takeover argue that they may enhance operational efficiency and discipline in efficient management. This is also correct. This is also correct. So only 4 was not correct. So A is the correct answer. A is the correct answer. Because for HHI, if you remember, both the numbers are important. Distribution concentration is also important. And the individual market share is also important. because you have to square the individual market share. Remember the formula? Yes. Now, moving ahead. Moving ahead. Next question. So I'm going away from the screen for now. What we will do is, if you have any sort of doubt for the paid batch, please raise your hand. I am going over the YouTube page. Next question. A listed company engaged in renewable energy projects witnessed a gradual increase in shareholding by Zenith. You know, everybody's enemy Zenith. Over the past 18 months, Zenith has been gradually acquiring shareholdings in Alpha. Zenith initially acquired 18 and later entered in a agreement of additional 9%. So 18 plus 9. कितना बन गया? 27%. Okay. Before completing the acquisition, Zenith appointed a SEBI-registered Category 1 merchant banker to manage regulatory compliance. During the offer period, the board of Alpha proposed a large asset sale and induction of 2 additional directors without seeking shareholder approval. They cannot do that. Meanwhile, another investor group announced a competing bid within 3 weeks of the original public announcement. Zenith also maintained a escrow arrangement partly through a bank guarantee. With reference to the SEBI takeover code. Now the question is different. They're talking about SEBI takeover code and related pricing guidelines. Consider the following statement. An acquirer crossing 25% shareholder must make an open offer for at least 26% of target's company share. Do you think this is correct? Yes. Yes. Now, important concept out here. Please remember, whenever a person acquires 25% or more of a company, but less than 50%, more than 25, but less than 50. Now, this person is an associate. This person has become an associate for the company. See, whenever a company acquires more than 51%, more than equal to 51%, even though in books it is written 50, but logically it is 51. This company becomes the holding company, and this is the acquirer company, and the company that was being purchased becomes the subsidiary, right? Becomes the subsidiary company, also known as target company. Correct? But what if my holding is more than 25 or more than 25, but less than 50? Then who am I? I'm a substantially important person, right? So I have become an associate. I have become an associate now, right? So they are saying that whenever there is an associate present, shareholding must make an open offer for at least 26% of the target company share. This is 100% correct. This is 100% correct. Crossing the 25% trigger requires a mandatory open offer for at least 26% of the shares. It is mandatory once you have crossed the 25% trigger point. Okay, next. A competitive bid can be made only within 21 days of the first public announcement. Correct. This is also correct. You have to remember these points because this is pure law. This is pure SEBI code. So you have to remember these things. During the offer period, the board of the target company, that is the selling company, may freely dispose substantial assets. Acha. You are being sold and you are being somebody is taking you over, and there are public offers being made, and now you can sell your assets. So that too substantial assets. Do you take us for a fool? Do you think we are mad people that we are putting our money into you and you are selling off your important assets out there? So this is not correct. You cannot do that. You cannot do that. Once the offer is being made, you cannot dispose of your substantial assets. छोटा मोटा asset बेचना चाहोगे, okay. Substantial assets, you cannot do that. For frequently traded shares, the 60 trading day volume weighted average market price may be one benchmark. Correct. You take a weighted average 60-day period average price. Correct. An acquirer holding between 15 to 75% can acquire up to 5% additional share without triggering an open offer obligation. True. This is also true. So only 3 is not correct. So C is the correct answer. C is the correct answer. If anybody has any doubt relating the code, you can ask me right away. If anybody has any doubts regarding this particular question or any question till here, ask. I'm giving you 2 minutes time. Ask. Anybody has any sort of doubt? Ask. Anybody has any doubt? Or should we continue? Please be active participants, you all. Okay, next question. A diversified company sought to acquire control of BuildMax, a company with strategically located limestone resources. The promoter feared that JPC's acquisition could eventually lead to restructuring of management and disposal of non-core business. In response, the promoter increased their stake through selective allotment of convertible warrants, very good, while simultaneously negotiating with another friendly multinational cement company. Meanwhile, JCP started purchasing shares aggressively from the open market. Okay, if you not sell, I'll buy it from the open market aggressively. Okay. What is open market? BSE NSE. And hinted at replacing the board after gaining control. Now that is pure threat. With reference to takeover strategies, anti-takeover defenses, and corporate restructuring mechanism, consider the following statements. A staggered board system makes it difficult for an acquiring company to replace the entire board immediately after takeover. If the board is already staggered, then it becomes difficult, right? If a staggered board divides director into classes. In a staggered board, what happens is that the directors are put into class with only a portion retiring each other. You cannot retire all of them together, right? Preventing a sudden loss of the board. You cannot immediately come in and say, I'll change the whole BOD. You cannot change the whole board of directors. You cannot do that. Sorry, wrong. So yes, if there is a staggered board, then definitely it is very difficult to change the entire board of directors in a single go. So this is correct. This is good. Correct. Next. Greenmail involves the target company purchasing shares from the hostile bidders at a premium in exchange for abandonment of the takeover attempt. This is also correct. Poison pill strategy increases the attractiveness of the target company. Wrong. It decreases the attractiveness. It is a poison pill, of course. Under creeping acquisition norms in India, promoters may increase their shareholdings within prescribed limit without necessarily triggering an open offer requirement. Correct. Pac-Man defense requires to a strategy where the target company launches a counter offer to acquire the hostile bidder itself. Correct. So only 3 was not correct. So A is the correct answer. A is the correct answer. Next. A private equity was evaluating the acquisition of the consumer appliances division of a diversified manufacturing company. The division had stable cash flow, modest capital X, capex bhi badhiya hai, and a professional management team. The buyer planned to finance nearly 75% of the acquisition cost through debt. Okay, I am the buyer. you are the seller. I am going to buy you. And for buying you out, what I'll do is I need money. So for this money, for buying you, I will take 75%. Let's say 100 crore was the amount. 75 CR I will finance through debt. I will raise my debentures, bonds, etc. into the market. I'll take a loan or something, and then I will take 75 crores via debt, expecting that operational restructure and disposal of surplus land assets would improve profitability. Okay. However, some analysts caution that excessive leverage could expose the venture to refinancing and liquidity risk. With a reference to LBOs, that is leveraged buyouts, consider the following statements. Interest payments on debt used in an LBO may create a tax shield that enhances the value for equity shareholders. Do you think the tax benefit is helping the equity shareholders? Correct, correct. Remember your EBIT statement. Remember your EBIT statement. EBIT minus I, EBT. Now on the remaining portion, you have to pay the taxes. If you would have paid with I, the tax would have been higher, right? Now, since I is out of the picture, let's say this was 100, this was 10. Now I have to pay tax only on 90. If there was no I, then I would have to be paying tax on 100 itself. So I is giving you a tax shield. Interest portion. I is what? Interest portion is giving you a tax shield. So this is correct. This is correct. Option number 2. Companies with volatile and unpredictable cash flows are generally considered idle candidate for leverage buyout. Do you think this is correct? Leverage is borrowing. You should take borrowings only when you have stable cash flows. If you do not have stable cash flows, do you think you are a good candidate to take out a loan? You do not have money for roti and you think you can take loan. This is wrong. In an LBO, repayment of debt through operational cash flows can increase the equity stake share in enterprise value over time. Yes, this is correct. Management buyouts are transactions in which existing managers acquire the ownership control of the business unit or company. Correct. High capex requirements and limited asset sale flexibility are regarded as favorable condition. No, it is adverse condition, not favorable. So only 1, 3 and 4 are correct. So B is the correct answer. B is the correct answer. Any doubt? Anybody? Please ask. Any doubt? Anybody? This is the time you ask questions. Okay, I have a question. Point number 3. Okay, sir, please write the question. Tanmoy sir, please write the question. Which point is not clear to you? I'll go back to that question because your message was a few minutes ago. Please type the question. Which question you are asking? Point 3, 4. Question number 10. Okay, let's go back to question number 10. Point number 3. During the offer period, the board of the target company may freely dispose of these substantial assets. See, there is already offer on the table, right? And you have at least in the initial 21 days, the offer has to be made. In the meanwhile, do you think you can sell off your assets? Do you think this is a wise decision? You cannot. You are not permitted to sell off your assets now, since the offer is already there. The public has been invited for open public offer now, so you cannot sell out your substantial assets. The target company cannot do that. This is pure law. These are proper provisions that are written in the law. Okay, sir? I hope it is clear now. Okay, next. If there are no questions, then I'll move forward. Okay, great. Next question, please. Question number 13. A leading company planned to acquire a renewable company overseas. The acquisition was financed through consortium of foreign lenders. The lenders evaluated the projected operating cash flows before sanctioning the loan. Okay, we are taking loan from outside India. The financing package included a mix of senior debt and subordinated debt. Okay, with pricing significantly above the ordinary corporate lending rates due to perceived regulatory and repayment risk. Okay, now the rate that we have got from them is very high. The Indian parent company provided corporate guarantees to support the borrowing arrangement. With reference to the acquisition or purchase financing and related concepts, examine the following statements. Acquisition finance is generally extended directly to Indian parent company, irrespective of whether an over SPV exists. Okay, now understand. This is an Indian company and I want to buy a foreign company. I want to acquire the foreign company. Okay. For doing this, I do have to create one SPV. A special purpose vehicle is to be created. We will pool our money into this. A pool of money will be submitted into this, and via this I can buy foreign company. They are saying that, and for financing I do not have that sort of money with me. So what I have asked is, I have asked some foreign investors only, foreign lenders, that please give me the money. We can put your money into SPV, loan me some money so that I can purchase this foreign company. And in order to do that, I will give you a guarantee. I will write a guarantee to the foreign lenders. This is what is happening out here. Okay. This is how acquisitions work. They are saying that you can finance yourself if you are an Indian parent company, irrespective if there is an overseas SPV or not. Do you think this is correct? No. This is incorrect. You cannot buy a foreign company overseas. Foreign also, we are talking about overseas company, okay? You cannot buy it until unless you have a SPV. That should be also overseas. That should be also overseas. So this is wrong. In acquisition financing, lenders commonly assess repayment capability using projected EBITDA. So, see, the lender will give me money. They do not know me. They don't know my reputation. So what they will do is, they will check my credibility. How will they do that? How will they check my credibility? By checking my EBITDA and future cash flows. So this is correct. This is correct. The pricing of acquisition finance may vary upon the legal enforcement as per the category of the debt that they are giving you. Yes, this is also correct. The rate that they will give me depends on different regulations that are happening and what sort of category of debt I am taking from that. Senior debt or subordinated debt. Mezzanine debt generally ranks below senior debt but above equity in repayment priority if there is a liquidation situation happening. So the mezzanine is just below the senior debt but above equity. That pay the senior debt first, then pay the mezzanine debt, and then you can repay the equity holders. Do you think this is correct? Yes, this is correct. So statement number 4 is also correct. Statement number 5. Acquisition finance necessarily carries out same interest cost as ordinary loan because overseas acquisition are treated as secure transactions. No. Overseas transactions are highly risky. If you are a foreign lender, you don't know me, I'm in India, you are in America maybe. Can you trust me? No, this is not ordinary lending that you're giving it to me. You are trusting me a lot. You're bending backwards for me here. So the interest rate has to be higher. It cannot be same as ordinary debt. This is wrong. This is wrong. So only 2, 3 and 4 are correct, which is D. Option number D is correct. A wrong, B wrong, C wrong, D is correct. Now, any doubt? Anybody, please ask. If anybody has any sort of doubt, you can ask me. People over YouTube, any sort of doubt? Okay, next. A leading Indian infra company planned to acquire a European company through SPV. Okay. Oh, this is a repeated question. I'm sorry. Yes. 2, 3, 4. Same question. It's been repeated. It's a repeated question. Sorry. A mid-sized Indian EV manufacturer wants to expand into Southeast Asia but lacked infra and advanced battery technology. Instead of acquiring another company, it entered in a multiple arrangement. A technology sharing arrangement with a Japanese battery firm. Okay, rather than buying a new company, I have entered into a joint venture. Okay, I have in a JA sort of a venture, that is joint arrangement with a local manufacturer in Vietnam. Okay. And a co-branding distribution partnership with regional logistic company. Okay, rather than, I do not want to spend that sort of time. You have one mean, I have another mean. So let's join hands. I'm not buying you, you are not buying me, we are equal partners. Okay, there's a marriage between two ventures right now. This is known as joint venture or joint arrangement. Okay. The management believe these alliances would help reduce cost and it is more beneficial than full acquisition. Okay. However, disagreements later emerged regarding decision making authority, that amongst us, who is going to make decisions? Timelines for inventory, allocation of operational responsibility. Which of the following statement are correct? Strategic alliance, also known as joint venture, joint arrangement, are often preferred in technology intensive industry because they facilitate sharing of expertise and risk. Do you think strategic arrangements are more preferable here? Correct. High technology industries, especially like EV, you have to pull in technological know-hows. You have to pull in technological advanced expertise of you and me together. I cannot work because there's a lot of capital involvement. There's a lot of risk. So yes. Statement number 1, correct. Statement number 2. Statement number 2 says that regulatory authority generally scrutinize joint ventures more harshly than mergers. No. They are more liberal for joint ventures because legally you are together for only one project and then you will part your ways. Then there will be divorce. You are here only for a child, then you will go away. Right? So, statement number 2 is incorrect because joint ventures are more favored. Statement number 3. This is correct, this is incorrect. Business alliance may serve as a preliminary step towards eventual acquisition of another company. So what will happen is, right now I am seeing whether we can work together. If I like you, then I can acquire you. Eventually I will acquire you. So what is this? This is basically dating. I'm trying to date you, and if I like it, let's have a live-in situation right now. If I like it, then we'll get married. This is correct. Complementary strengths and clarity of roles are important determinants of alliance success. Correct. If there are more strengths than me alone, if we together have better strengths and the roles are very clear in our heads, then definitely we'll have a better success. Large advertising, storage and distribution costs can encourage firms to enter alliance for market access. Correct. These are primary reasons why alliance is done. So only 2 was not correct. So 1, 3, 4, 5. B is the correct answer. B is the correct answer. Next. KPMG conducted a post-merger review of several missized industries. Let me check if anybody has any sort of doubt. Then I'll read the next question. Very good, Albin sir. Shabash. Correct answer. I'm very proud of you, sir. Next. Okay. KPMG conducted a post-merger review for several missile technology acquisition and found that many acquiring firms struggle not because of financing issues but due to integration failures, unrealistic synergy, and managerial obsession with scale. One such company acquired a smaller AI startup. The management justified the premium paid by projecting aggressive cost savings and cross-selling opportunities. However, after the acquisition, conflicts emerged regarding organizational culture, employee retention, incompatible reporting system, and differences in strategic priorities. The acquiring company also discovered pending legal liabilities that had not been seen as a reputational setback. With reference to acquisition and merger, examine. Okay. Acquisition premiums generally compel acquirer, the purchaser, to generate post-merger value exceeding the additional amount paid over market valuation. If a premium is paid, do you think a post-merger market valuation should be justified or not? Correct. Correct. Acquisition premiums, pre-acquisition, whatever your price was, I have paid you above that, so that is why it is a premium, right? Market value creation, only if post merger there is market creation, only then this premium is justified, otherwise this premium is not justified. So this is what they are saying, that market acquisition premium generally compel acquirer to generate post merger value, that now I have given you extra money, now at least work together and create more income. Yes, this is true. This is true. Diversified acquisition into unrelated industries are always superior because they reduce the concentration risk. No, they are more of a headache. So this is wrong. In acquisition negotiation, separating operational evaluation terms from negotiation teams may reduce emotional bias in bidding decision. Yes, let's involve a third party. There should be no emotional bidding. Correct. The winning curse in acquisition refers to a situation where the highest bidder may have overestimated target's value. Just in order to win from my competitor, I bid higher, and this is a winner's curse because I paid more than what it should have been paid more than what I can ever recover. So this is also correct. This is known as the winner's curse. Successful integration after acquisition mainly depends upon accounting consolidation and legal transfer rather than cultural compatibility. No, cultural compatibility plays a very big role post-merger for post-merger valuations. So only 1, 3 and 4 are correct. So A is the correct answer. A is the correct answer. Any doubt, anybody till here? Please ask. If anybody has any sort of doubt, please ask. Okay. So what we are going to do is we will start with unit number 18 now. And after that, okay, let's do few more questions. I think we'll end by 12:30, I guess. So just 2-3 more questions from this unit and then we will start with unit 18. I think I have 18, 19, just 3 more questions in this unit. Hey, don't worry, I am also awake with you all. A diversified manufacturing Operates across chemicals, consumer appliance, and renewable energy. Over the last 3 years, the company faced declining profitability due to high debt, duplication of distribution network, and an inability to scale. At the same time, its renewable energy division was attracting strong investor interest. The board decided to restructure the group. So let's restructure it. First, the logistic division was sold to another corporation. Later, the renewable energy business was converted into a separate listed entity. Simultaneously, the promoter discussed separating unrelated family controlled business into independent entities. Based on corporate restructuring, divestiture, and demerger, and carve-out concepts examined. In a equity carve-out, the parent company may continue to retain controlling ownership even after shares of the subsidiary are offered to the public. Do you think this is correct? This is correct. So what happens is, in a carve out, what happens is, always remember this concept. Now this is holding company, okay, also known as parent company. And this is my okay, my subsidiary company. So what will happen is, I have 51% or above of this whole company. I have above 51% or above, right? Maybe I have 80% of subsidy in my name. 80% of this subsidy is with me, and the rest 20 is with the common public. So what will happen is, I need money. So what I'll do is, I'll carve out. How will I carve out? I will open only 29% of the remaining 29% of the remaining shares for the general public. For the general public, what did I do? I gave them only 29%. 20% was already with the general public, and I gave out more 29%, making it 49%. Still, I have the controlling interest, 51%. See, now do you understand why do I say that 51% determines who has the controlling interest? Because if I would have given more, all 30%, then you also had 50, I also had 50. How come I have the control? No, only 51% and above will give me control. Only and only 51% and above will give me controlling interest. So what did I do? I did keep the control with myself, even though I did give out some shares to the public. So yes, this is correct. This is correct. I am still the parent company, right? A spin-off necessarily generates immediate cash flow to the parent company because shares of the subsidiary are sold to outside investors. Incorrect. This is not correct. This is carve out. This is not spin-off. Spin-off क्या है? Spin-off में generally there is no cash because shares are distributed proportionately to the existing shareholders. Rather than giving it to the whole public, what I do is, current shares are proportionately distributed to the existing shareholders only. So statement number 2 is incorrect. Statement number 3. My throat is going, I can feel it, but just one more unit, so don't worry. One motive behind divestiture may be the inability of business division to achieve critical mass or operational synergy with the parent company. See, I was working with the parent company, but somehow there is not an operational synergy between us. So do you think divestiture will help us? Yes. It is a strategic move where parent company and the subsidiary company are unable to operate together. with synergy. There you divestitate it. So third is also correct. In a split up agreement, we both were together, we formed a new company. Now we have said that we need a divorce, we should split up. So in a split up arrangement, the original parent company legally survives while the other division becomes independent. No, both of us are independent now. So this is wrong. We are split up. There is no marriage now. I am no longer a parent. You no longer have control over me. There has been a divorce now. We have already split our ways. So this is incorrect. Nobody is a parent company now. Okay, we are two independent individuals now. Two independent entities. Lastly, partial sell-off. Partially I have sold off a unit. Are viewed as contraction from the seller's perspective, but expansion from buyer's perspective. Correct. Partially I have sold off a unit to you. So yes, for me it is a contraction. I have there has been a contraction for me, but for you, since you are buying out, so it is expansion opportunity for you. So 1, 3 and 5 are correct. So C is the correct answer. C is the correct answer. Just 3 more questions, everybody. 3 more questions only, and then we will move to the last unit. Any doubt, anybody? Please ask. Any doubt, anybody? This is where you ask questions. Okay. Next. Zenith Motors decided to sell its battery accessory division. I'm selling off my division. After facing liquidity pressure and increasing management complexity, the division operated in a business unrelated to a company's primary business activity. Before taking the final decision, the company estimated division's future post-tax cash flow and identified a sustainable discount rate and compared the expected sales. Consider the following. A sell-off may help a company improve focus on the core business. See, I was doing a business. I had various divisions. And few of the divisions that I had no expertise also over it. They were not even related to my own business. For example, like I was a business. I was selling milk and byproducts of milk. For example, I was selling milk, I was selling butter, I was selling ghee, I was selling curd, I was selling chach. 5 divisions. Then out of nowhere, I started selling cold drinks. Do you think cold drinks are even associated to me, or any ancillary service or something which will help me with this milk business? No. Right? So, and because of this, I'm unable to focus on my main business because this cold drink is taking up all my energy. So, do you think if I sell off this cold drink division, it will improve my focus on the core business operations? Do you think that will happen? Yes, correct. If I divestiture, then it will definitely help the management for core business. Correct. The valuation of a division for divestiture purposes should consider post-tax cash flow. Yes, I should take into consideration the tax implications. So yes, post-tax is to be taken into account. Correct. Next, the book value of division-specific liability will always be equal to the market value. It is a no-brainer. Book value will always be equal to market value. Not possible. Not possible. Reverse synergy suggests that a business unit may be more valuable under different ownership. I'll give this ownership to somebody else. This will create more synergy within me. Yes, great. Correct. The divestiture proceeds exceeds the value of ownership position. Selling the division may be financially beneficial. Yes. Yes, correct. It will be financially beneficial only. So 3 was not correct. So A is the correct answer. A diversified conglomerate decided to restructure its business portfolio. Any doubt till here? Ask. Any doubt till here? Please ask. Okay. Next question. A diversified decided to restructure. Okay, the company transferred its underperforming renewable equipment to another corporation for lump sum कि भैया ले जाओ हमको पैसा दे दो मोटा, ठीक है, without assigning separate values to individual assets liability. हमको नहीं पता each asset each liability is for how much. I want you to take the whole business for 70 CR. That is it. I do not want to go into the mata pachi of it. I don't want to go into the depth of it. Now you take it. It is your responsibility. You individually assign value to these assets and liabilities. The division has been held for over 5 years. Simultaneously, the company explored ways to unlock shareholder value by considering the separation of one of its profitable logistics subsidiaries. Management believed that independent operations would improve accountability, entrepreneurial motivation, and strategic focus. Makes sense. The board also discussed raising funds by selling minority stake in the logistics subsidiary to outside investors while retaining control. Control is mine. I'll sell a small portion. Which of the following statements are correct regarding sell-off, spin-off, and equity carve-out? Equity carve-out, I sold off only a few shares to the public by retaining the whole ownership with me. Spin off, I've given a spin, and sell off, I have sold one small division. In lump sum sale, the transfer consideration is generally assigned separately to each asset and liability for tax computation purpose. Do you think I've given a lump sum sale? Slump sale hai. Do you think this is correct? I will go ahead and assign value to each asset and each liability. No, that is why I went for lump sum sale, na? Because I don't want to do this. So this is incorrect. This is incorrect. Long-term capital gains arising from slump sale may qualify for concessional tax treatment, though indexation benefits is generally unavailable. Correct. Indexation will not be given to me because I don't know the individual asset and how, when they were purchased, what was their CII. I don't know that. So that benefit I'll not get. But I'll get a concessional tax rate. That is correct. A spin-off may improve managerial accountability because separate management team becomes more directly responsible for business performance. So now I have as one different management team under my control only to please manage this. So yes, correct. In an equity carve-out, shares or subsidy are typically offered to new investors, to outsiders, and the parent may receive cash proceeds. Correct. And equity carve-out and a spin-off are identical. No. Wrong. So only 2, 3 and 4 are correct. So C is the correct answer. They are not identical because I do not distribute shares to the existing shareholders. I only offer it to the public, the general public. Okay, next. Last question for this unit. Then we'll start with our last unit, which is again pure theory. So yes, we'll complete it. We are going to complete it within 1 hour, most probably. A diversified business group operates across telecommunication, renewable energy, logistics, and financial services. Due to succession-related concerns among promoters, family members, and increasing regulatory complexity, the board decided to reorganize the corporate structure. The company retained its core infrastructure business while transferring the financial services into separate companies. कह रहे भाई हमको हमारा काम दे दो, बाकी तुम ले जाओ. Okay. Existing shareholders received proportionate shares in the newly created entity. Makes sense. Certain minority shareholders questioned whether the reconstruction would qualify for tax incentives and whether the new entities could independently assume liabilities related to transferred undertakings. In a separate strategic review, the board also explored creating a holding company to improve centralized control. Okay. So which of the following statements are correct? A holding company can exercise effective control over another company even without majority ownership if shareholders' dynamics permit such influence. I can have effective control on some other company even though I do not have 51% and above of them, just because I have influence over them. Just because I have influence over them. Do you think this is correct? Yes, 1000% correct. Control doesn't necessarily mean that I have 51% of your share. Control means I can influence you. Control means that majority of your board of directors are under my influence. I am sitting here and I can take major decisions of a company which is in some other state just by sitting here. That is my influence, right? Then too, I am a parent to you. Then too, I am a parent company to you. Just like if your mother-in-law can control everything in your household, even though she's not living with you, she is the parent controller, right? Same ways. In a qualifying demerger, the resulting company, there's a demerger. We were together, now we have demerged. The resulting company, a new company that I have formed, assumes liability related to the transferred undertaking. Now, whatever has been transferred, they have the liability. They will assume the liability and they will also have the tax benefits or tax qualifications. They'll have it. Correct. This is also correct. In a split up, the parent company necessarily continues to exist even when one division becomes independent. No. There has been a split up. There has been a divorce. We are two different entities now. You are not my parent anymore. So this is wrong. One objective of forming a holding company structure is risk mitigation. Correct. A risk is divided amongst two. A tax-favored demerger, shareholders holding at least 3/4 of the value of the demerged company should become shareholders of resulting company. Correct. At least 3/4 of the shareholders should become the shareholders of the new company as well. So this is correct. So only 3 was not correct. So B is the correct answer. B is the correct answer. Making sense to all? Everybody, please. Is it making sense to everybody? Okay, last unit and I'll let you go. Last unit and I will let you go. Deal structuring and financial strategies. It is already 11:30. I will try and conclude this in the coming half an hour. Okay, since it is a smaller unit comparatively. So what is deal structuring? I am trying to design the acquisition transaction. I am purchasing, you are seller. Okay, you are the target company, I am the purchaser. There has to be a deal broken between us, right? Who will do that? So for that we have separate entities. So a deal structuring will be made between us. A structure will be made. A deal will be made, which should talk about how will tax be taken care of. What is the legality of this merger or acquisition? How accounting will be done of it, and how will I finance this acquisition or merger, right? So 4 important aspects that I have to take into consideration while making a deal to you. So what are these important considerations? Tax, legality, accounting, and financing. I can either make you a cash deal or I can swap shares with you. These 2 things I've already mentioned. Either I can give you money, go out, or I can give you shares of my own company. Now my ownership will be diluted, but still I did not have to pay you money. Or it can be a hybrid, cash plus shares. Makes sense. Exchange ratio, vendor upon purchaser. I told you victim upon problems. Sorry, victory upon problems. Very easy. Exchange ratio is target upon acquirer. Numerical questions are common from here. We have already done that. Now, leverage buyout, that also we have done. How do I do? So whenever I want to acquire, I will finance myself via debt. High leverage is there, tax benefit is there, and private equity participation is there. Then what are cross-border acquisitions? Global expansion is there. I'm sitting in India and I want to acquire a company that is in America. This is cross-border acquisition. New market will be there, technology acquisition will be there. But there are certain risks. There will be regulatory risk, currency risk, and political risk. Now, goodwill is what? If I'm paying you 70 crores, but your net asset value, that is your assets, minus liability is only 50 crores. So what is the goodwill? Extra 20 CR that I've given you is my merger cost, right? It is, you name it as goodwill. You name it as goodwill. So when will goodwill arise? Only if purchase price is more than net assets. Only if purchase price is more than net assets. But it could be the other way around also, right? I've given you 60 CR even though your worth was 70. So what is this 10 CR? What is this 10 CR? This 10 CR is known as purchase bargain. This is known as a bargain situation or capital bargain, purchase bargain, whatever you want to name it. A diversified manufacturing group planned to acquire a logistical technology company to strengthen its supply chain integration. During negotiation, disagreement emerged. Assumptions of contingent liabilities, post-merger governance rights, and the use of debt. The acquirer preferred a highly leveraged structure, that is leverage buyout, right, to preserve cash reserves, while the target company insisted on safeguards against future litigation. Now I am buying you out. You will work with me now, right? But you are concerned that, from where are you getting the money? I said that I'm taking a loan. So you said that, it is not good. We'll have a future litigation. And then there will be some, let's sort some out of equity, right? Let's take some loan and some should be from equity. The advisor also warned that modification in tax structure and acquisition vehicle could significantly alter the finance cost. Which of the following are correct? In an asset purchase transaction, the acquirer may selectively assume specific liability instead of automatically taking over all liabilities of the target entity. We are saying this is not a merger. This is an asset purchase transaction. Both the things are different. Now understand, whenever there is not a total control shift from the target company to the purchasing company, it is merely an asset transaction. You are merely purchasing my assets, nothing else. You are not my parent company now. This is not acquisition. This is not a merger now. This is merely a asset transaction. That is it. Asset purchase sale transaction. That is it. You are not having control over me. So if that is the case, if it is a asset purchase transaction, now then if I'm just buying your asset, then why will I take over all your liabilities? I will buy only those liabilities which I feel are fine for me. I will assume only specific liabilities. Do you think this is correct? Yes. If you are not naming this transaction as a acquisition or merger and you're not giving me the control, it is a mere asset acquisition transaction, then why will I take all your liability? I will only take selective liabilities. The buyer can negotiate which assets and liabilities it wants to acquire further. So if it is not stock acquisition, then there is not a control transfer, then okay, it is just asset transaction. Then this is only asset purchase transaction. So this is correct. Next, earn-out arrangements are often used in M&A to bridge valuation gaps between the acquirer and the acquiree, that is the target fund. This is also correct. Whenever there is a disagreement between the buyer and the seller over the valuation and the linking part of the purchase consideration, so what you do is you take out a earn-out. So this is also correct. Leverage buyouts generally depend substantially on borrowed funds. Correct. A stock for stock acquisition necessarily eliminates all tax implication. No, this is not correct. There will be tax implication. Whenever you will sell it, there will be a tax implication. Change in the form of payment and financing structure can influence risk allocation. Yes. First you are saying you will take loan. Now you are saying you will go via equity. This is a risk. So post closing agreement, this is a risk. So only 4 was not correct. So A is the correct answer. A is the correct answer. Next question for you all. A diversified manufacturing group, Tata Group, planned to acquire a mid-sized robotic company across Europe and Southeast Asia. The target company had unresolved environmental claim, accumulated tax losses carry forward, and highly independent management team for at least which you have to retain for at least 3 years. Okay. The acquirers board debated whether the use of divisional structure, a holding company, or a partnership based arrangement after completion of the transaction. Simultaneously, a private equity investor offered a co-invest. Based on the acquisition vehicle and post closing organizational consideration, which of the following statements are correct? Okay. A holding company structure may help isolate liabilities of the target company from the parent company. If there is a holding company structure, if I'm your holding company and you are my subsidiary company, then your liabilities are not my liabilities. Do you think that is correct? Do you think that is correct? Yes. Because holding company structure are often preferred. I will create a new structure known as holding company structure. When you have so much of liability, there are so many substantial liabilities, and with liabilities which can be ring faced with you, right? That I can just create these, I can create a ring around these liabilities and I can leave them with you because of the legality of the new structure that we are forming, the holding company structure. Do you think this will happen? Yes, you can do that, and this can happen only and only with holding company structures only. This is a very legal form of it. That is why it can happen. Okay. Immediate post merger integration is generally easier under a divisional or corporate structure. Correct. If there is a centralized managerial team, right? If there is a centralized managerial control, now the control is centralized. So it is easier to work now. This is correct. Partnership or LLP may allow operational losses and tax benefits to pass through owners, reducing double taxation. Now there will be no double taxation. Let's create a LLP or a partnership. This is also correct. Joint ventures always accelerate integration. Wrong. Selection of an acquisition vehicle is influenced only by taxation. No, we have to take into consideration how flexible this vehicle is, how the management control will be transferred, and how the management control will be centralized. So this is also wrong. So only 1, 2 and 3 are correct. So C is the correct answer. C is the correct answer. I hope there are no doubts here. If there are any doubts, please tell me in the chat box. If there are any sort of doubts, please ask. Okay. Next question, please. A mid-sized pharmaceutical company planned to acquire a fast-growing biotech startup. The startup possessed significant intangible assets and uncertain cash flows and multiple products still under development. Okay. Alpha already has a relatively high debt equity ratio after 2 earlier acquisitions and wanted to preserve borrowing capacity. Okay, they already have taken a lot of debt, और ना हो पाएगा, और हमको मत दो, ठीक है? The founder of the company were also interested in participating in future upside of the merged entity rather than existing completely. During negotiations, the acquirer considered several payment alternatives, including cash, equity shares, convertible instruments, etc. Based on the concepts, which of the following are correct? Acquirers with actually higher leverage than desired leverage are generally more inclined towards non-cash acquired structure. Already, I have a lot of debt. Now, will I move towards a structure where I have to pay less cash or not? You tell me. Logically, you tell me. Yes, I already have a lot of borrowings. Now, I would like to give you my equity. भैया शेयर ले लो, हम पैसा नहीं दे सकते. We cannot give you more money now. We already have taken a lot of loans. We have already a lot of borrowed fund with us. We cannot take more. We cannot pay out more cash. So this is 100% correct. Convertible securities may reduce valuation disputes because they provide downside protection along with potential participation and future appreciation. They're saying that, I'll give you a convertible debenture right now. Right now, you do not have any ownership. But in the future, when our company will grow, then you will have ownership. Do you think it is good? It's a good proposal? Yes. It's a downside protection. The protection is not right now, it is on the downside of it. This is also correct. Okay. A company whose shares are perceived to be undervalued is usually more willing to finance acquisition. No, they are less willing to finance acquisition through stocks. I'm already undervalued. Why will I give you more shares of my firm, my company? I know my valuation is 100. Right now, people are buying me at 60. And you are saying that I should give you my shares. No, I will give you my shares when my shares will be traded at 120. Not even at 100. Why will I give you my shares now? I know my worth. My worth is much higher. Target shareholders may prefer a mix of cash plus stock. Correct. But they will retain exposure for future. Correct. Multiple options bidding strategies involving cash and stock eliminate uncertainty. No, that cannot be done. You cannot completely eliminate it. So 1, 2 and 4 are correct. So A is the correct answer. A is the correct answer. Okay. Next question. Zenova Technologies and Indian Software Infra plan to acquire a loss-making data analytical enterprise. During negotiation, Zenova advisors debated whether to structure the transaction as a cashable cash asset, taxable cash asset, a taxable stock purchase, or a tax-free stock reorganization. The finance team observed that they possessed valuable patients with low net book value with high market valuation. The target company promoters preferred avoiding double taxation and wanted continuity in the business. Meanwhile, Zenova's board was interested in enhancing post-acquisition cash flow. While examining restructuring options, the legal advisors also warned that transaction lacking genuine commercial purpose or continuity of ownership could fail the regulatory scrutiny under tax reorganization principles. Which of the following statements are correct? In a taxable cash purchase of target asset, this is a cash purchase. You are my target asset now. The acquired asset may receive a step up in tax basis to fair market value. Do you think I will have a tax benefit because now I was buying you, right? The book value is low, but your market value is high, or vice versa, right? I should get a tax benefit, right? I bought you out. I should get a tax benefit over it. Yes, you will be stepped up to fair. Another taxation will be as per the fair market value and not the book value. So this is correct. This is correct. A taxable stock purchase generally reduces the likelihood of double taxation. Correct. This is also correct. This is also oh, sorry. Read the whole line. I see. A taxable stock purchase generally reduces the double taxation of target shareholders compared to asset sale followed by liquidation. No, if there will be asset sale during liquidation, there will be double taxation. So this is incorrect. Incorrect. Once you sell it further, there will be taxation. I was taxed for selling it. Now you will be taxed for selling it ahead. So of course there will be double taxation. In a tax-free reorganization, continuity of ownership generally requires target shareholders to retain a meaningful stake. Yes. If I am buying you out, your shareholders should become my shareholders. At least a good amount should be there. Forward triangular cash mergers are generally treated as taxable acquisitions. Correct. It is a taxable acquisition of stock, not just of asset. This is correct. NOLs can never be carried forward in India once control of the company changes after acquisition. Wrong. We can carry them out in India. We can. So 1, 3, and 4 are correct. So A is the correct answer. Okay, I think we have. Okay. Yes, there has been a mistake. In the answer, let's read the question again. Last 4 were incorrect because the forward triangular cash mergers are treated as tax acquisition of assets because it is a triangular cash merger. So yes, sorry, I read it wrong. So point number 4 is incorrect, even though point number 2 is correct. Point number 2 has to be correct since it is a stock purchase, it is not an asset purchase. So I read it wrong and I read it as asset purchase, but it is a stock purchase. It directly occurs between the acquirer and the target company, right? Shareholders are not involved. So the structure actually avoids double taxation. Even if there is a liquidation after that, then too, it is directly between the target company and the acquirer company. So shareholders are not a part of it. So this is also correct. So 1, 2, and 3 are correct. So B is the correct answer. B is the correct answer. I read the question wrong. I am sorry. Let's take a break for 5 minutes. I think I am also very tired. That is why I read the question wrong. So let's take 4-minute break. Okay, everybody, I'm back, refreshed now. Let's do the next question. Yes, B should be the correct answer. 1 is correct, 2 is correct, 3 is correct, 4 and 5 are not correct. Because for reverse triangle cash merger, it is a stock purchase. But for a normal cash merger, it is a asset purchase. Okay, next. An Indian company engaged in telecoms proposed an amalgam with another Indian company suffering heavy accumulated losses. Trian had been carrying on its business for more than 4 years before the amalgam and held substantial fixed assets, continuing during the preceding years. After amalgam, JCP intended to restructure operations by selling a large portion of fixed assets within 2 years and discounting one major business division. The tax team also examined whether accumulated losses, depreciation benefit, and MAT credits of Trian could be utilized. Certain shareholders of Trian received shares of JCP as consideration under the scheme. Which of the following statements are correct under the income tax? Okay, under section 47, subsection 7, exemption from cap gain to shareholders is available only where the amalgamated company is an Indian company and consideration received in form of shares. 100% correct. You only get tax exemption if you are an Indian, if the acquirer was an Indian company, plus they gave you shares of their own company. So correct. MAT credit of amalgamating company automatically transfers to amalgamated company under section 72A. Wrong. Wrong. You have to retain the assets. This is wrong. This statement is wrong because if you wish to take MAT credits, there is no express provisions under section 115 JAA. MAT is for 115 JAA, permitting any automatic transfer. Okay. Courts and authorities have examined the issue. I'll say that yes, there have been a lot of debate, but the matter has always gone into litigation. Always. So you cannot automatically just transfer it. There are certain conditions attached to it, holding conditions, and those two also have gone into litigation. So for as of now, they are not automatically transferred. So statement number 2 is incorrect. Statement number 3, if the amalgamated company fails to continue the business for the prescribed minimum period, previous set of losses will become taxable now. Correct. You have to continue the business for a prescribed period at least for getting these benefits. If you have previously taken off the set off, now pay tax over it if you cannot continue with the business. So we will feel like you did this just for evading tax, so you have to pay tax now. For availing benefit under 72A, the amalgamated company is generally required to retain at least 3/4 of its book value of assets. Correct. For a prescribed period, you have to retain at least 3/4 of its assets. You cannot sell them off. Cap gain under section 45 necessarily arise only upon actual receipt and not upon accrual receipt. Wrong. Even if it is accrued, we will assume that there is cap gain, even if there is no actual receipt, even if it is deferred, then also there is cap gain. So statement number 5 is incorrect. So 1, 3 and 4 are correct. So A is the correct answer. A is the correct answer. Any doubt still here? Any doubt, anybody? Is my voice clear? Let me check over YouTube. Is the voice clear? Oh my, sorry. Let's take a break from language. I think I'm also very tired. But 1, 3 and 4. So everything is fine. Everything is fine. Let's move ahead. A Limited acquires 60% of B on a closing date, obtaining control over its operation. 51% above, right? The acquisition involves transfer of cash and assume identifiable assets and liabilities. I have given you cash, I have taken assets, liabilities. The finance team is preparing consolidated FS and evaluating how goodwill and NCI and acquisition related costs will be done as per global reporting and IFRS based business composition. For us, for Indians, it is Ind AS 102, 103 and 110. Always remember that. The acquisition method requires identify the acquirer, determine the acquisition date, and recognize the assets and liabilities at fair value. 100% correct. With goodwill or bargain purchase in P&L. In P&L, do you think this is correct? Yes. Yes, all assets and liabilities will be taken over at fair value only on the acquisition date. Okay? And if there are any sort of bargain purchases, then it is recognized in P&L. It was, their worth was 60, I paid them only 50. Then it's my bargain purchase. It's a during purchase I got a good bargain. This gain will go to P&L. But if there is any sort of goodwill, like your worth was 70, I paid you 80, so 10. The extra payment that I've given you, goodwill will go to balance sheet. This is correct. Correct. NCI at the acquisition date will be measured either at fair value or proportionate share. Correct. Correct. They are saying, now I have taken your 60% of the share. Rest 40 is for with somebody else. So that those somebody else's are NCI, non-controlling, and they have non-controlling interest. They cannot control this company. So how do I measure them? I have to measure them as well. So either at fair value or proportionately how much share they have in the company, as per that net assets will be assigned to them. Okay. Goodwill arising on business composition is amortized systematically over its useful life. Oh, no amortization. No amortization as per IFRS. It is not amortized. It is only tested if there is any impairment. Only test is conducted for impairment. It is not actually amortized. Acquisition related costs such as legal and advisory fees are included in consideration transferred and capitalized as goodwill. No, they are written off in P&L. They are written off in P&L. You write them in profit and loss account. You do not put them as a part of purchase consideration. No. A bargain purchase gain, if arises after reassessment of net assets, is recognized in other comprehensive income. No, P&L only. P&L only. So the correct answer is C. 1, 2 are correct, 3, 4, 5 are incorrect. Okay, so the question said which of the following were not correct. So 3, 4 and 5 are not correct. So question number B is the correct answer. Is the correct answer. Read the question properly, everybody, please. The next question. A global customer electronics company is planning a large acquisition to expand into emerging market. The firm is considering multiple financing structure, issuing equity, internal reserves, long-term debts, etc. The management is also evaluating how capital market condition, investment sentiment, and post-merger cash flow can influence. The CFO is particularly concerned about maintaining financial flexibility, EPS creation, and managing credit rating post-transaction. Which of the following are true? A company may issue equity before an acquisition specifically to signal that proceeds will be used for future acquisitions, which can influence investor clientele and value recreation. Now see, I am saying I want to purchase you. Okay, but I do not have the money. So the selling company is saying, but I need the money. So what I'll do is, I'll issue my shares for general public, somebody else. I'll issue my own shares. The buying company will issue their own shares to the general public and get money from this FPO, right? I have gathered money from this and I've told them that this particular issuance is dedicatedly for my expansion, that I want to buy somebody else. That is why I have issued these shares. Can I do that? Yes, you can do that. Yes, so statement number 1 is correct. A company may issue equity before acquisition. I want to buy you. Before buying you, I've issued my own shares to the general public. I'll get money from there, right? That money I'll use for acquisition. High leverage always increases a firm's financial flexibility because it ensures lower dependence on equity market. No, no. You are actually taking more loan, more borrowings, and it will reduce the flexibility. This is incorrect. Convertible bonds typically offer lower coupon rates. Yes, since I've given you an option. If you would have taken normal bonds, they would have given you 10% interest rate. Now, because I have given you bonds which you can convert into equity after 5 years, so now you will not get 10% interest rate. You will get only 7 to 8% interest rate. So this is correct. Post-merger firms with highly correlated cash flows are more likely to reduce leverage due to increased variability in combined earnings. No. When the correlatedness is less, that is, typically the cash flow is more, I have a risk of cash flow volatility which will decrease now. So this is wrong. I will not reduce my leverage, I will increase my leverage now. I will increase my borrowings now. Why will I decrease? I know my cash flow is going to increase. So let's borrow the money. We'll pay the interest payments. Right? Credit rating agencies evaluate the debt risk based on factors as funding stability, interest coverage, leverage levels. Yes, correct. We'll take care of all these things. So 2 and 4 are not correct. 2 and 4 are not correct. So B is the correct answer. B is the correct answer. Any doubt? Anybody? Any doubt? Please ask if you have any doubt. An Indian conglomerate is evaluating multiple funding routes via overseas acquisition. Okay, same question like we did for SVPs. The treasury team is comparing domestic banks and NBFCs, and if I issue a bond for via non-convertible debentures, and if I borrow offshores within India, what all can I do, and outside India, what all I can do. They are also assessing regulatory constraints. Which of the following statements are true? In India, commercial banks are generally restricted from directly financing the acquisition of equity shares, except in limited cases permitted under prudential regulation of RBI. Do you think commercial banks are restricted? Correct. RBI framework generally restricts the bank from financing equity acquisition. They tell you that you cannot finance somebody who is going for an equity acquisition. Only a limited regulatory approvals are given, which are also not that common. Okay, so this is correct. NBFCs are regulated by RBI and typically operates with comparatively broader lending flexibility. Yes, correct. Commercial banks have more regulations over them. This is correct. Next. External commercial borrowings, ECBs, can be used without restrictions for direct investments in equity shares. No, not correct. FPIs are permitted to invest in listed debt instrument. Yes, only in listed. Correct. This is also correct. Leveraged buyouts are expressly prohibited under Indian law. No, we do them. This is wrong. And these are very common these days. So 3 and 5 are not correct. 3 and 5 are not correct. So C is the correct answer. C is the correct answer. Okay. So that was it for this unit. Now I'm going to give you last minute revision formulas. Book value, present value, Gordon model also known as GTM, P valuation, asset value, exchange ratio, goodwill. These formulas, if you do, you are done. These formulas, if you do, you are done. So that is it from my side. I'm going to end the session now. I'm here. I'm waiting for another 10 minutes. If you have any sort of doubts, this is the time where you ask questions. We are done with Module C. All important concepts, all important numericals, all important formulas and theory questions are done. If you want more numerical questions, please comment in the comment box over YouTube paid batch can directly message me, and I'll bring up with more numerical questions if you require it, even though you do not require it now, because we have done a lot of fair share of our numerical portion as well. But if you want it, do let me know, and I will 100% come up with a series for just numerical questions from module C. If you do this, see, listen to me, if you do this current session, you have done around 80 to 90% of module C now, which is more than enough for you right now. If you have not even started, even once you have not done anything, it is not the time to start afresh. It is time to smartly work now. It is time to smartly grow through my marathons, where you know what questions will be asked and how they will be asked. So that is the time where I've given you conceptual clarity, I've given you numerical formulas, I've given you examples, I've kept the language very, very simple. So yes, it is not the time where you can go through the book now. It is the time where you should go through the marathons now. If you have any questions, ask me. I'm here. I have done the whole module with you. For the paid batch, important information, we will start with module B revisions every morning, most probably 6 to 9 a.m. And if not that, I'll share the details over the paid over the app or WhatsApp group, where that what will be the timings. Don't worry about that. So yes, if you have any doubts, do ask me. I'm here for another 6-7 minutes. If you have any doubts, please ask. If you go through this marathon, you are done. Believe me. And if you want to do more numerical questions, you can also type that in the comment box, and I will do it for you. So don't worry about it. Okay. So all the best, everybody, for the upcoming exam. For the paid bag, I have a gift for you with all the revision classes that will take place this particular week. And just one thing that I'll say before going away, that I say always, that always love your parents, spend time with them as much as you can. They're growing old, you have to take care of them. They took care of you when you were younger. And be a nice person. Love everybody. Believe in the Almighty. Show love to people who are special to you, especially to your spouses. They really need it, and they have been doing a lot of things for you. So it is time to give back. Once you become a better person, nobody in the world can pull you down. Once you are a better person, in your individual capacity, you will 1000% become a better person professionally. So keep your heart clean, eat your vitamins, take your multivitamins for sure. I am suffering through multivitamin deficiency as of now, so I've made this as my current agenda to have my multivitamins. You too have it, and all the best for your exams. You will rock it. You are going to excel in the upcoming exams. Believe in that, and you will do it. All the best, everybody. Take care. This is Radhika Mam signing off. Bye bye.